As long as there's cash in people's pockets and FOMO, markets are going to continue to grind.
The tailwinds for the market is basically the speculative frenzy that is going on right now.
A lot of what the issues are that could result in a repricing, they're all out there. The question is, are the markets reflecting that?
The market is expecting lower rates. This is what the beginning of a new bull market looks like.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Friday, dissent is brewing.
Looking across the soft and hard data, I get a picture of a labor market on the edge. Policy should look through these tariff effects and focus on underlying inflation, which seems to be close to the FOMC's 2% goal. I believe it makes sense to cut the FOMC's policy rate by 25 basis points 2 weeks from now.
Fed Governor Chris Waller pushing for a rate cut, suggesting the labor market is on edge. As Fed Chair Jay Powell is attempting to address criticism coming from the White House, the U.S. equity market is cutting through the noise and heading into the weekend sitting at fresh all-time highs.
And part of the reason why is because companies are saying things are actually looking better, and there is more confidence coming from consumers, and you saw that reflected in the hard data yesterday with retail sales coming in better than expected. So then we have to turn to the Fed. The idea of strength versus weakness, the fact that Fed Governor Chris Waller is talking about potential weakness and the need to cut. Is that because of a lack of inflation, or is it because there is something emerging under the hood that maybe equities are not picking up on?
Later on this morning, a must-watch conversation, 8 a.m. Eastern Time, 2 hours from now. A conversation here in New York City with the man himself, Governor Chris Waller. If you went through that speech last night, two big assumptions here, Bramo. A large share of tariff increases won't be passed through to consumers, one, and two, any increase would fade over the next year or so.
And it all comes down to, in terms of the why, the labor market not seeing the wage increases that would perpetuate some sort of inflation over a longer period of time. He said, looking across the soft and hard data, I get a picture of a labor market on edge. And he said that the risk to a weaker jobs market is greater and sufficient than the risk of inflation to cut rates. He might have some company. An increasing number of Fed members seem to have a similar kind of idea as he.
Just how much dissent will we see at the end of this month? This is going to be music to the ears of this president who spent the whole week going after Chairman Powell.
Absolutely, especially when Christopher Waller came out and his first point was about tariffs, saying tariffs are a one-off price increase in price levels. Standard central bank practice is to look through these price level effects, given the fact that the Fed chair, Jay Powell, has continuously said we need to wait for the tariff rates to decide whether or not we're going to cut rates. Also, interesting part, Q&A session. Has President Trump or anyone in the administration asked you to take on that role? Nope. Next question.
Nope. This is not political. Remember that the last time Governor Waller spoke? Let's talk about the data. This week, retail sales decent. Jobless claims better. Downside surprise on CPI, on PPI. You're going to have a very split FOMC at the meeting in a few weeks' time.
Especially because it's not just Chris Waller and Governor Bowman. It's also Mary Daly, the San Francisco Fed president, who spoke with our own Michael McKee and talked about how she does see a growing risk, and she's increasingly of the view, similar to Chris Waller, that the inflation coming from tariffs isn't going to be sustained. I just wonder if it's going to be two dissenters or if it's going to be more.
Chairman Powell might be increasingly lonely, facing more and more criticism down in Washington, D.C., and writing a letter, I believe, or getting someone to write a letter back to the White House to talk about how seriously they take public resources.
Right. He went to the OMB director, Russ Vought, with this letter, talking about the fact that, yes, they have this transparency now when it comes to renovations. They want to be honest with the administration. They say they have been transparent. The Fed has also added a web page for transparency on the renovations, according to Powell. He says they deny that there's VIP elevators. He defends the roof that they had to fix. Quote, there are no special private or VIP elevators being constructed as part of the project. Quote, there are other references in the plan to vegetated roofs, often referred to as green roofs, which are commonly used to help with stormwater management to increase building efficiency and roof longevity. Green roofs are found on other federal buildings like the Department of Justice. So really trying to make this case that what we are doing is normal procedure, and other institutions and buildings have done it as well.
I get the feeling even with this letter, this story won't die, right? It's not going to die.
I did not have on my bingo card for 2025 that we all would be scrutinizing the line items of the renovation of the new Fed building, yet here we are.
Here we are. Here we are, doing okay. Equity futures on the S&P positive once again by 0.1%. Coming up this hour, we'll catch up with Peter Oppenheimer of Goldman Sachs with stocks back at all-time highs. Tobin of Wolfe Research as Fed Chair Jay Powell responds to the White House, and Henry McVey of KKR on Governor Waller's push for a July rate cut. We begin this hour with stocks at all-time highs and Fed Governor Chris Waller pushing for a rate cut. Peter Oppenheimer of Goldman Sachs writing, while US fundamentals remain solid, the valuation premium is increasingly difficult to justify. Peter joins us now for more. Peter, welcome to the programme, sir. Let's talk about the valuation premium and the why. The data this week is good. The earnings have been okay. Absolutely. And we've got an FOMC slowly leaning towards a rate cut. What's not to like?
Well, John, I think this is a relative rather than an absolute story. You're right. If interest rates are coming down, and we think they are, and the economy continues to grow, if even at a more moderate rate, generally that's a good backdrop for risk assets and for equities. And the US is no exception, particularly as it's increasingly again dominated by its biggest tech stocks, which are generating really strong earnings growth. But it's really the relative premium against other markets which has reached a record high, which is harder to justify when other markets are beginning to see their own tailwinds. Europe, for example, is enjoying stronger growth. You know, we think about last year, the US economy was growing at nearly 3%. Germany was stagnant. By next year, they'd likely be growing at relatively similar rates, and yet the valuation gaps are extremely wide, and that's an opportunity, we think, to diversify.
It is a question of where you diversify, given the fact that a lot of people are expressing it through the currency, and the currency is having a balancing effect in so many ways, given the fact that it might actually be a tailwind for U.S. corporate earnings and a headwind for European ones. How do you factor that into this equation?
That's a very good point and absolutely right, and particularly for the dominant tech stocks, which are very global in terms of their revenue streams, and they have very strong balance sheets. A weaker dollar will help them. So that is good indeed for the dominant companies in the US. And from an earnings translation perspective, it's a headwind in Europe or indeed Asia. But on the other hand, in terms of flows, what we're beginning to see is more appetite for US investors to spread their risk, to diversify, to benefit from some currency gains that they may get in cheaper markets like Europe or emerging markets, for example. And indeed, it's also an increasing incentive for investors in Europe to keep more of their funds at home. So from an earnings translation perspective, it's a headwind in Europe, it's a tailwind in the US, but from a diversification perspective for investors, I think this is likely to encourage a broader spread of assets than we've generally seen over the last decade.
How interest rate sensitive is this story at a time when some people are talking about possibly an ECB cutting rates more quickly than a Fed, and then a question of whether maybe the Fed will cut rates just as quickly in perhaps a different composition at the Fed?
Well, we're more mature through the interest rate cycle in Europe, at least in the Eurozone. We're expecting one more rate cut, getting policy rates down to 1 3/4. We think we have a series of rate cuts to look forward to in the US to get policy rates down to 3, 3 1/4. What I think is worth also emphasizing, though, is that while there are prospects for bigger rate cuts from a higher level in the US than perhaps in Europe, long-term interest rates are not really coming down. And that's a reflection, of course, of concerns about debt sustainability and debt financing, not just in the US, but in other countries as well. Bear in mind, in Germany, while we're getting these policy rate cuts, long-term interest rates are actually edging up as it also finally increases its borrowing and fiscal spending, which is good for growth, good for the equity market, but of course puts upward pressure on long-term interest rates.
Peter, speaking of Germany, the Bundesbank president today came out and said that challenges to Fed independence, which he calls in the DNA, the autonomy of good central banking, would resonate beyond the shores of the United States. What kind of impact could we see if we were to see the president of the United States get rid of Jay Powell and fire him in Europe or inside Asia and emerging markets?
Well, look, we shouldn't forget that independent central banks have not always been the norm throughout history, and this was something that really gained prominence in the 1990s and beyond. Of course, that has helped both to bring down inflation, to bring down inflation risk premia as investors have become more confident in stability, and have brought down risk premia and the cost of capital in general. I think anything that challenges the independence of the central bank will be reflected in higher risk premia. But I think we're a long way away from that. And as you've been saying in your reports, the conditions in the US are favouring interest rate cuts anyway. We're getting into a more benign phase of the cycle after the big inflation rises that we saw following the pandemic. Unemployment's edging up a little bit, and there is room to cut rates. That's true in the US, it's true across Europe, the UK, and other areas as well. And by the way, some weakness in the dollar and interest rates coming down in the US will resonate and be positive, I think, beyond US shores. Very beneficial, for example, for emerging markets also, which have tended to lag behind over a long period of time. So I think there's a long way, we're a long way away yet from people really worrying about central bank independence.
Let's hope you're right, sir. It's going to catch up. Peter Oppenheimer of Goldman Sachs. Peter, thank you. A little bit later this hour, we'll catch up with Henry McVey of KKR. Henry making the point we're about to see a global easing cycle, of which I'm sure the ECB and the Fed further down the road might be a part of.
Yeah, and this really speaks to the question of, is it justified at a time where you potentially have a lot of productivity gains, and you potentially have this entire investment cycle? And that's also part of what Henry McVey is talking about, the idea that we're about to see a reindustrialization akin to what we haven't seen for a very long time on the heels of AI that allows that disinflationary force along with strength.
What I find interesting in the intersection of politics with all of this, if people are starting to say that we're going to see rate cuts brought up, I mean, you have Christopher Waller talking about happening in the next 2 weeks, then Trump might get what he wants and Powell might still be the Fed chair. He might not have to fire him, and he's still going to be able to get what he wants right now, because some of the data for some people are pointing to the fact that there is an opening to bring interest rates down.
So much drama this week. Stock market all-time highs going into the weekend. Equity futures this morning positive by another 1/10%. Let's give an update on stories elsewhere this morning with your Bloomberg brief. Here's Lizzie Burden. Hey, Lizzie.
Hey, John. Fed Governor Chris Waller is calling for the Fed to cut rates when they meet later this month. Waller said that inflation from tariffs will be temporary and warned that while the labour market looks fine on the surface, private sector job growth is near, quote, stall speed. Waller will join surveillance at 8 a.m. Eastern this morning. Elsewhere, Netflix beat expectations across the board in the second quarter, posting revenue of $11.1 billion. It also raised full-year guidance, forecasting $45 billion in sales and near 30% margin. The company's market cap now exceeds $500 billion as it leans into content and ads amid rising global competition. And President Trump has been diagnosed with chronic venous insufficiency, a common condition causing swollen ankles. The White House medical unit says he remains in excellent health with no signs of DVT, heart failure or systemic illness, and doctors attribute the recent hand bruising to aspirin use and frequent handshakes, calling it benign. That's your Bloomberg Brief. John.
Lizzie, thank you. More from Lizzie in about 30 minutes' time. Up next on the programme, pressure building on Fed Chair Jay Powell.
I think, again, this is a good use of taxpayers' time to look into this project that is millions and millions of dollars over budget. It's for a big, beautiful mansion for the federal chairman, reserve chairman.
Up next on the programme, Tobin Marcus of Wolfe Research, live from New York City this morning. Good morning. Two days of gains on the S&P 500, heading into the weekend at all-time highs and adding just a little bit of weight to the rally this morning. Up 0.1% on the S&P. On the Nasdaq, up 0.1% also. Bramo yesterday, Mike Wilson, Morgan Stanley. This is what the beginning of a new bull market looks like.
And a lot of people seem to agree with him. Henry McVey of KKR, you mentioned him, he's going to be on later, seems to agree in the sense that suddenly we see this investment from AI percolating through the entire corporate ecosystem. That is what we're seeing in earnings, and that is the reason why people are looking past all of the noise in the headlines. They're sick of them. They want to just see what the companies are actually doing.
Freaking out for the last several months about policy. I get it for good reason. You sat down with Scott Kirby of United Airlines. When you listen to these business leaders right now, just stay in the course. Seem pretty confident about the back half of 25.
After they saw the one big beautiful bill passed, companies got a lot more confident. People started traveling more for business. But then you saw consumers sick of just being numb by headlines. They want to travel. They want to spend. Watch what they do, not what they say. When you watch what they do, they're still going out there and living just as the way that they did before.
If you are just tuning in, welcome to the program. Stocks on a record-breaking run once again on the S&P 500 this morning, just about positive. Under surveillance this morning, pressure building on Fed Chair Jay Powell.
I don't believe there's a deadline the president has set for Rust Belt, but I think, again, this is a good use of taxpayers' time to look into this project that is millions and millions of dollars over budget. It's for a big, beautiful mansion for the federal chairman, reserve chairman. It's completely unnecessary. It's overpriced, and I think it's a good thing the administration, led by the president, is looking into it.
Here's the latest this morning. Fed Chair Jay Powell responding to White House criticism over the Fed's renovation project, writing in a letter to the Director of the Office of Management and Budget, "We take seriously the responsibility to be good stewards of public resources as we fulfill the duties given to us by Congress on behalf of the American people." Joining us now from Washington, Mike Shepard. Shep, as we said at the start of this program, this story just won't die.
Eager to keep this one alive because, in a way, they are trying to lay the groundwork for a possible case to move against Powell if President Donald Trump really does want to set up a decision to fire him. At some point, they would need some grounds. They would need some cause. And we have heard the president and his allies. You just heard White House Press Secretary Caroline Leavitt refer to it again, making these accusations of lavish spending. The Fed chair is trying to counter all that, pointing to the fact that, look, these buildings that constitute the Fed headquarters near the National Mall here in downtown Washington, they're nearly a century old, and they need extensive upgrades. They have not been renovated really since they were constructed in the 1930s, and they need extensive abatement of lead and asbestos and other safety upgrades for fire and ventilation purposes, too. But look, John, this is really far less about a renovation project. It's really about whether the Fed chairman will heed the president's call to lower interest rates. This is a case that Donald Trump made in the Oval Office on Wednesday with Annmarie Hordern right next to him, practically, hearing him argue for lower rates. But right now, the Fed chair is not ready to bend to the president's will. He is not prepared to do so. He wants to see the data. For Donald Trump, the data are there. He is calling for this. He sees the European Central Bank making moves in that direction. He's also looking at what many are seeing as relatively low or tame inflation, giving the Fed enough leeway to act. So we're going to have to be watching this very closely, both on the renovation front and on the body language when it comes to interest rates. John.
Mike Shepard, thank you, sir. Shep, we'll catch up with you in the next hour. Joining us now to extend the conversation, Tobin Marcus of Wolfe Research. Tobin, welcome to the program. Endgame. Just what is the endgame right here in Washington?
So I think the endgame remains to be determined by the president. I think that what we're seeing now in terms of the investigation and the heavy public criticism of this renovation project is giving him optionality, which has often been the approach in this administration. I think they're trying to create a legal predicate if they need it, since the Supreme Court has made clear that they're not going to accept a Fed chair firing without cause. You know, that we're seeing a kind of pretextual effort to establish cause if the president decides to go down that road. But I do not think that a decision has been made.
Well, if a decision hasn't been made, though, and he continues to go after Jay Powell, potentially to give him an opening to firing, but if he doesn't, and say we even see the Fed chair come out and announce at some point between now and the end of the year a Fed cut, what kind of damage is being done in this interim?
I think as long as nothing really dramatic actually happens, it's not going to be the kind of thing that worries markets long term. I think it's going to, it'll continue to worry those of us in the policy community. It's not a great thing to see. There's definitely a process of kind of politicization going on in terms of a more overt effort to put pressure on the Fed. Obviously, it's not completely insulated from political pressure, sort of cycle in and cycle out. But this is clearly more overt than we typically see. But I don't think it's going to be something that, concretely impacts markets if they don't actually go ahead and make a real attempt to fire him.
As Mike Shep was saying, I was in the Oval Office with the president on Wednesday, and we were questioning him about this. And walking in, I saw the renovations underway for the Rose Garden, a second time for this president. We've also seen this president also have cost overruns when it comes to Air Force One. Does this argument work for someone who has also had renovations and cost overruns?
I think when you're looking at the renovation project objectively, it's expensive. It is somewhat overcost. I'm sure it has not been executed perfectly. But to your point, government renovation projects, government, projects in general, very commonly run over cost. So, again, I think it's fairly clearly pretextual. If they do end up in litigation over this, like the fact that it's pretextual doesn't necessarily mean that it won't work. I do think there will be some reluctance from the conservative majority on the Supreme Court to second guess executive discretion about what constitutes cause. The kind of legal definitions about what constitutes cause are fairly vague and have not been extensively litigated. There are these general terms like inefficiency and neglect of duty. So again, I think they can make the case. But it does certainly put those of us in the policy business in an unusual position of being, experts on beehive costs and marble and so forth these days.
Tobin, it's true. And we all are sort of wondering how August or July of 2025 became the renovation month where we all became experts. I'm curious if you understand why. Why now? Why we're getting this sort of push to get rid of Fed Chair Jay Powell after there had been a lot of discussions earlier this year. The economy is doing okay. We are seeing a stock market near all-time highs. Do you have a sense of the timing and the purpose behind it?
Well, look, I think the president has been pretty clearly frustrated with Powell for a long time, and this is something that he has been thinking about on and off. To your point, we've had sort of another cycle of this in April when the speculation about a possible firing reached kind of a boiling point, and then they took down the temperature a little bit. So I think the frustration has never gone away, and it's sort of bubbling to the surface again based on the latest data. I mean, to your point, the fact that markets are at all-time highs is something that President Trump has pointed out as a reason to cut rates. I think most of the folks in the Fed system would look at it the opposite way, that's a source of, easy financial conditions that would not necessarily make you think that you need to cut rates. It is kind of a murky data picture. I think the arguments on both sides are pretty real, but I don't think that Powell's going to change his position anytime soon.
How much support does President Trump have in Congress to really go through with a move like this?
I think he has enough support to get a successor confirmed, which is all that really matters. There's plenty of concern about this. You have had various Senate Republicans going on the record with their concerns over the course of the past few days, but I don't think they're going to do anything about it. I'd be very, very, very surprised to see anything like a threatened embargo of a potential successor if Powell is ousted, which is really the kind of point of leverage that they have. I really do not think anyone's prepared to cross that bridge. And short of that, he referenced the enthusiastic reception he got from House conservatives when floating this possibility the other day. Again, the sort of senators and moderates are more apprehensive, but all of them, I think, are hoping for an outcome rather than trying to effectuate it.
Tobin Marcus of Wolfe Research. Tobin, thank you, sir. You're right to keep pointing out all-time highs in the equity market. I wonder how long they'll last if you do fire the Fed chair.
It depends on whether the market responds pretty much the way we imagine that it would, which is a weaker dollar and higher long-term yields, because essentially this would undermine some of the long institutional belief that, yes, the Fed is independent. Is that part of the reason why President Trump is reluctant to really take this ultimate step?
Market's not pushing back yet, though, is it? And we've talked about this a few times with regards to trade as well. Is that a market ignoring some of these policy threats or endorsing them? And the president reflected on that to start the week, suggesting that maybe it's an endorsement of some of these threats.
Or is it a market that's had its face ripped off 15 million times and is sick of getting whipsawed by a headline that gets reversed to prove a point? So they're not going to even do it. So ultimately, President Trump is playing chicken with a market that doesn't want to respond too soon. It sets up a pretty uncomfortable situation.
That right there is the sound of exhaustion going into the weekend. Just exhausted by some of these stories, not just you. I think all of us. Coming up on the programme, Jason Bazinet of Citi on another strong quarter for Netflix, plus Saira with your morning movers, and an update on the race to power AI. later on this morning, in about 1 hour and 30 minutes time, a must-watch conversation. Governor Waller, 8 a.m. Eastern time, right here, live and exclusive on Bloomberg Surveillance, making the case for a 25 basis point rate cut. The big push starts right now.
Saying that the risk to the labor market is clearly more of a concern to him than any kind of potential prolonged inflationary wave coming from tariffs. Is this the shadow Fed chair? How much clout does this type of proclamation have on the broader committee?
I'm not sure he'd describe himself as that.
I can guarantee he won't.
But others might in the months to come. Equity futures on the S&P 500, just about positive. Welcome to the program. 2 days of gains into Friday, going into the weekend at record highs. On the Nasdaq 100, just about positive, 2 unchanged so far this morning. With 3 hours until the opening bell, let's get you some morning moves and cross over to Yahaira. Hey, Yahaira.
Hi, John. It was another blowout quarter for Netflix, but as you can see, shares are lower by 1.6%. That's because the stock has had a huge run-up in the past year. But as I said, another exceptional quarter. Profits, revenue, and forecasts all topped expectations. And given its international presence, a weaker dollar helped contribute to that. It's also part of the reason why it expects net income to exceed $10 billion for the first time ever this year. So quite the milestone for the streamer. And we move on to Circle. Those shares are up 2% after Congress handed the crypto industry a big win. Lawmakers passed the first federal law to regulate stablecoins, the digital tokens tied to the dollar, and Circle is one of the companies that issues those coins. And there is no shortage of deals in the energy space due to the AI boom. And here is the latest. It involves Talon Energy, which is up nearly 15% after announcing a $3.8 billion purchase of 2 major natural gas plants in Pennsylvania and Ohio. This is as we see the biggest surge in electricity demand due to AI in decades, and these gas power plants are able to provide that around-the-clock power needed to power them. John?
Yahaira, thank you. More from Yahaira in the next hour. On our radar this morning, one of our top stories, Fed Governor Chris Waller saying the central bank should cut rates this month. Waller saying the labour market is, quote, on the edge, and policymakers should not wait until it worsens. This is a forceful argument against a key line coming out of the Federal Reserve over the past few months. The economy is solid, and we can wait. Here's a gentleman that's telling you the economy is no longer solid.
He's pointing to the private payrolls. When he says you look under the hood, you can see that any kind of increase in some of the payrolls number has come from public sector hiring, and it doesn't speak to the kind of strength that would lead to wage increases. That's a key component of any kind of inflationary wave. The reason why we're focusing on him, I think, might be more interesting than even his argument, which is he is considered the dark horse to be the next Fed chair. Is his view taking disproportionate clout when it comes to swaying other members, especially with some of the jawboning coming from the White House?
What is so interesting about his case right now is that, of course, he is a name that continuously gets called upon, potentially that can become Fed chair. But this is someone who, because he is making an economic case, and he's not just throwing, spaghetti at the wall in terms of how bad Jay Powell is for a number of things like renovations. He's making an economic case, which means he's credible inside the institution. He's credible to economic voices at the White House, and he's credible, most importantly, to the market.
I heard the same thing from Neil Datta of Renmac, that if you want lower rates, that's the guy that can help affect the situation, because he's inside the institution, giving you a credible economic argument to lower interest rates, and he can bring the committee with him. You select someone from the outside, to your point, Annmarie, that quest, that mission is a whole lot harder.
If you have someone who's quoting the Beige Book as a justification
for
why to cut rates, get on board. If you have someone who's saying you need to overhaul the whole institution, and really this is just a total bungled organization that has caused inflation to take off, well, it's a little bit of a harder sell and lacks the same kind of credibility.
We'll give Governor Waller some time to present his argument a little bit later this morning. Again, don't miss that at 8 a.m. Eastern Time, a must-watch conversation. Let's turn to this story. The EU hitting Russia with a fresh round of sanctions over its war in Ukraine. The EU cutting off 20 additional Russian banks from international payment systems and setting a tight curb on fuel made from Russian crude.
So this goes back to the oil price cap, and they proposed moving it from $60 a barrel to $45. They ended on $48 a barrel. What I would note is that this is an important development, and it's really being welcomed by Ukraine in terms of continuing the pressure on Russia. But the start of the year, I can't get over this report for the Center for Research on Energy and Clean Air. The EU is spending more money on Russian fossil fuels that they continuously import than they are on financial aid to Ukraine. And the EU has yet to completely end its reliance on Russian oil and gas. They're going to do that not this year, not next year. The aim is for 2027.
When you break it down like that, the whole thing sounds absolutely ridiculous. For all the calls of the Europeans to get the United States to put pressure on the Russians, when you hear it broken down the way you just did, it's just absolute nonsense.
It sort of points to the moral high ground. Who really has it in terms of taking a hard line on Russia? And at this point, how much clout does Europe have, even with each other, to get each other on board to execute some of these potential policies?
That's the latest on the war between Russia and Ukraine. I wanted to squeeze this story in. Wells Fargo suspending travel to China after one of its top traders was blocked from leaving the country. The US Embassy said it raised the case with Chinese authorities. China's foreign ministry said it wasn't familiar with the situation.
Meanwhile, Wells Fargo has banned all travel, at least temporarily, for its employees. What a shocker. This really just goes to underscore why it is so difficult for multinationals in the United States to do business in China. And increasingly so, especially if any individual over in that country is used as a pawn in any kind of escalating trade war. I know that, John, you've been eager to get to China. I just wonder if that's going to be, potentially something that hampers that.
I don't think John will be going to China anytime soon. But China's use of exit bans has been this point of contention between Beijing and Washington. The State Department repeatedly advises citizens to reconsider travel to China based on what it calls the arbitrary enforcement of local laws, including what happens with exit bans. And this is why you see a number of banks and companies really scale down how much they want to send travelers over to China.
It's getting harder and harder to do business in both countries at the moment, let's put it that way. Let's turn to the earnings. Netflix reporting better than expected second quarter results and raising its full year forecast. Jason Bazinet of Citi has a neutral rating and a $12.50 price target on Netflix, and he joins us now for more. Jason, welcome to the programme, sir. Decent numbers. Stock's a little bit lower in the pre-market. Do you think that's just a reflection of what a strong rally we've had year to date of something like 40% plus?
I think it's a little bit the rally and a little bit the source of the beat was really the weaker U.S. dollar. So it's sort of viewed as a sort of low quality beat, if you want to think about it that way.
So if you strip out the FX tailwind, Jason, what's left?
In terms of
where the
why else they
performance
beat
came
the quarter?
from?
Yeah. I mean, look, they had decent pricing growth. They had decent sub growth. I mean, they're definitely growing in ways other than a weaker U.S. dollar. My only point is the source of the beat was primarily related to the weaker dollar.
It goes to the question of how high the bar is at this point for the earnings, especially given the fact, as John mentioned, it's up more than 42% so far year to date. I just wonder if this is still a growth stock in the same kind of way, given that they no longer provide subscriber information and they're really facing off with pretty significant penetration.
Yeah, no, I agree with you. I mean, if I went back 18 months ago, the bull case on Netflix was a 25 multiple on 25 earnings. And now the bull case is a 40 multiple on 2027 earnings, which the bulls would argue is $1,600 a share. The question is, why so much multiple expansion from 25 times to 40 times? I would argue what Netflix has benefited from is really sort of a safe haven status from PMs. They look at Netflix, they say there's no AI risk, there's no recession risk, there's no government intervention, there's no tariff risk. So if you owned one of these big mega cap companies and you go look for a safe harbor, Netflix checks all those boxes, and that's why you've seen the multiple expansion. The question going forward is, can it hold this multiple? And if you look at street numbers and even the company's leaked memo, it talks about top line growth decelerating over the next 4 years. So that's the real question. Can the multiple hold at this elevated level if the top line is going to decelerate going forward?
There's a deeper economic question underpinning this as well, which is, do they have the power to raise prices substantially, given the fact that a lot of people are concerned about the trajectory for the average consumer? Do you get the sense that people are overestimating their ability to keep charging us more and more?
When I do the math on Netflix, their price per consumed minute sits right on top of linear television. So the threshold question is, can they continue to grow engagement? The troubling thing that is beginning to happen, and it came up over and over again on the earnings call last night, is Netflix is sort of winning the battle against pay TV as pay TV declines. It is losing the war relative to consumers' consumption of video. And the best example of this is over the last 18 months, Netflix and YouTube were at parity of 8% of U.S. Viewing share. Netflix is still 8%. They've been flat. And yet YouTube has gone from 8% share to 12%. And so what consumers are saying is they want to embrace these sort of open platforms, lean into the creator economy, where Netflix really isn't participating. And that's the challenge. If they don't get their share of viewing up, then it's going to be difficult to continue to increase prices.
How could they participate in that space?
Well, there's sort of the half step and then there's the full step, right? The half step would be to go into some of the most iconic creators on YouTube and give them their own show on Netflix, which is produced by Netflix, greenlit by Netflix. That's sort of the half step. The full step would be just to go in a more full-throated way and set up a parallel business very similar to YouTube, where you just sort of open up your platform, you let people upload videos to it. And then there's all sorts of questions around, does that dilute the Netflix brand? Is that, content high quality enough? And so those are strategic questions that Netflix is going to have to answer.
And how would they make money in that case? Would it just be through traditional advertising?
Well, yeah, exactly. I mean, if you look at YouTube's, payout, it runs about roughly half of all the revenue that comes in is paid out to the creators. It's not totally obvious to me that would be dilutive to Netflix's margins. If you look at their cost of goods for all the content that they produce, it's sort of in that same zip code.
Jason Bazinet of Citi. Jason, appreciate you jumping on to catch up with us. Thank you, sir. Stock is lower in the pre-market by close to 2% after a major rally so far year to date.
What he was just talking about is fascinating, how quickly YouTube has gained against Netflix. And I wonder how much this is just that people's attention spans are really low.
Getting shorter and shorter.
And so if you have some kind of cute little clip that's really attention grabbing, that's generated specifically for you.
Speaking from experience, aren't you?
That you can handle it for about 2 minutes.
Just sit there scrolling.
And you don't fall asleep.
I want to see your Explore page.
Please don't. Can you imagine? Yeah, that's me.
Just sort of golf clips on my end. Just sort of sit there scrolling.
Sure. Yeah.
Then they filter tennis in. If you watch it for too long, all you get is tennis. Just like that.
It's pretty much anything.
I know.
It sort of reminds you of your bad habits in real time.
Sports, apparently. We're down about 1.7% on Netflix. You haven't shared your bad habits.
Fine.
I don't know what you're looking at.
Mine is rehabilitation of abandoned pets.
Okay. That's what, you do that in the morning or at night?
Let's move on.
Okay. All right. That sounds fine. Let's get you an update on stories elsewhere this morning. Find something new out every single day. Here's your Bloomberg Brief with Lizzie Burden. Hey, Lizzie.
Hey, John. President Trump authorized the Justice Department to seek the release of grand jury testimony in the Jeffrey Epstein case. The move came after the Wall Street Journal published a story alleging that Trump sent a suggestive letter to Epstein for his birthday. Trump called the accusations fake, and it's unclear whether the testimony, which is typically kept secret, will be released. Elsewhere, Burberry shares are getting a boost in London trading. The luxury fashion house reporting a smaller than expected decline in comparable sales. It also saw better than expected growth in its Americas segment. And Apple is losing more top talent. Sources telling us here at Bloomberg that Meta hired a pair of key AI researchers who work for the iPhone maker's Superintelligence Labs team. Earlier this week, Zuckerberg posted on Threads that Meta would invest hundreds of billions of dollars on advanced AI. And that should be my brief, John.
Hey, Lizzie, thank you. More from Lizzie in about 30 minutes' time. Up next on the programme, Governor Waller pushing for a rate cut.
I believe it makes sense to cut the FOMC's policy rate by 25 basis points 2 weeks from now. And looking to later this year, I would support even further 25 basis point cuts to move policy towards neutral.
Up next on the programme, Henry McVey of KKR, live from New York City. You're watching Bloomberg TV. The president up early, going after Chairman Powell once again. Here's the quote from this post this morning. Too late in the Fed, choking out the housing market and their high rate makes it difficult for people, especially the young, to buy a house. Goes on to say, he is truly one of my worst appointments. Some acknowledgement of the fact that he did appoint him to be Fed chair.
Yeah, it does raise a question of how he's going to avoid making that type of what he would view as a mistake going forward in his next Fed selection. How can he ensure that if they're looking at the economic data and that really is the driving factor?
That line is standing out to me. He's truly one of my worst appointments because on Wednesday, the president said who appointed this guy, and then Joe Biden reappointed him, pretty much glossing over the fact that actually it was Trump and his administration that first gave Powell that job. So here is a little bit of introspective looking from the president of the United States saying, I actually put him there, and it wasn't a good decision.
If you are just joining us, welcome to the program. Some division emerging at the Federal Reserve. Under surveillance this morning, Governor Waller pushing for a rate cut.
I believe it makes sense to cut the FOMC's policy rate by 25 basis points 2 weeks from now. And looking to later this year, if, as I expect, underlying inflation remains in check, with headline inflation data reporting modest but temporary increases from tariffs, and the economy continues to grow slowly, I would support even further 25 basis point cuts to move policy towards neutral.
Here's the latest this morning. Federal Reserve Governor Christopher Waller pushing for rate cuts. Henry McVey of KKR writing the following. Our glass still half full thinking is that attractive financial conditions, a global easing cycle and ongoing productivity gains will continue to drive this cycle both further and longer than many people think. I'm pleased to say that Henry joins us in the studio. Henry, good morning. Good to see you.
It's great to see you. Thanks for having me in.
Thanks for being here. Let's talk about the price of the story. You say markets are reasonably valued and not overvalued. What's the difference between the two?
So I think what we've seen over the years is that the quality of the S&P has actually improved, right? You cut taxes, corporate taxes went from 31 to 21, so there's more free cash flow. The second is that the index has moved to be more towards services companies that have a higher return on capital, and then they have higher margins. So I think what we've seen, this whole rally has been fought. If you go back, we were up 55% the last 2.5 years. And generally, there's been a lot of noise out there, and so people have not gotten fully invested. Our view is that the cycle will go on. This is like the 90s and the 60s where you have a productivity-driven cycle. They last longer. 2022 was like 1994 where the bond market sold off. People moved to the sidelines. You really wanted to buy that in 1995, and it ran for another 5 years. We think that's very similar. Productivity-driven cycles, they just act differently, right? Most people would say ISM's been below 50 for 26 out of 27 months. And we haven't had a recession. There's something different going on, and we've seen this 1 or 2 other decades. We own 200 companies around the world. We've got lots of different data points on how corporates are functioning. And when COVID hit, what they did is they really focused on automation and digitalization. We were talking about this a little bit before, and that spending is yielding really good results. I don't actually think we've had the AI boom flow through the data yet. And so that's, I think you have to keep that in check, but I think that could be a little more addition to this productivity-driven cycle that we've seen. It's largely in the U.S. I mean, I travel all around the world. We've got 24 offices, but most CEOs today need, for competitive reasons, to invest in technology, and they're squeezing more out of their business and their cash flow.
If you have this huge investment boom, you have a huge technology cycle, and you have consumers that are hanging in there. We just saw that with retail sales. What gives you confidence that inflation is going to come down enough over the long term to lead to a global easing cycle? Yeah, so this is a great question. My actually view, we've been talking about at KKR, this higher resting heart rate for inflation this time. The Fed has told us they're going to miss their mandate for 7 years in a row. I bet there are very few of your viewers who actually were investing when they missed it 7 years in a row. So I actually don't think in the U.S. it's going to come down. What's different, the global easing cycle, we track the top 25 central banks around the world and what they're doing. In 2022, 84% of them were raising rates. Today, only 8 are. So they're starting to ease. This cycle was actually led by the ECB. It's the first time we actually had the ECB out in front of the Fed. So I think inflation will stay stickier here than in other places of the world, but you have to look at it on a global basis. And one other point I would say is that when I started doing financial services and macro, the Fed's balance sheet was about 6% of GDP. Then it went to 34% during COVID, and then it's back down to 22 to 24%. That's still a huge number. That's a multiple of 4 versus normal, and that money is sitting on the sidelines. And it is, particularly in the insurance arena, that money needs to get invested to make the retirees actually achieve their returns. So the credit markets this cycle, you have less bank deleveraging, you got higher quality, high yield, and then you've got this kind of tsunami of money that needs to get invested. One of the things that I love about our platform is we can look across relative value across the capital structure, and what you see, it changes by day in terms of where there's value in credit, but overall it's behaved
incredibly much more benign this cycle than in the prior cycles.
And the higher yields has led a lot of people to say this is the golden era for credit, particularly private credit, and moving away from private equity.
Yeah.
And we've seen some real concern about exits not coming to the fore, and now universities selling some of their PE holdings for liquidity. Why do you push back against the idea that this really could lead to some sort of material weakening in the base of your original business?
Yeah, so what I would say is one of the reasons in 2006 and 2007, KKR probably over deployed a little bit. You have to have linear pacing when you do private equity. This year, in 21, 22, and 23, we did kind of a quarter of the fund. That's the way you never have to make a big bet. What the industry did is it probably, in general, overinvested in 21 and early 22. So they're going to have to work that out. So I do think we've led to some differentiated outcomes. I think for the industry, though, what you're starting to see right now is monetizations pick up a little bit, the IPO market's opening over time, and you've seen this real shift in our focus. This is a world where you're going to make more private equity, kind of make your own luck through operational improvement, corporate carve-outs, public to privates. I think there'll be less that vintage where many in private equity were going private to private investments. I don't think those deals will perform as well. We certainly, one of the reasons I have a job is we had made that mistake in 2006 and 7, and I think the industry will catch up to where we are after this latest cycle. So I'm not as, for overall, I acknowledge there was over deployment for the industry in 21 and 22. I don't think we're suffering from that. And in general, what I would say is that over time, if you're a long-term investor, private equity has delivered about 400 to 500 basis points better than most public equity markets.
We just have about a minute. America versus Europe.
Yeah.
Which do you prefer? And it's because you don't believe in American exceptionalism.
I think that what we're seeing in both regions they're going to perform. The U.S. today has better companies. What the sentiment coming out of Davos was so negative on Europe. If they just did anything, you guys reported on this. Yeah. If anything went well, they delivered. Interestingly, Europe has actually been one of our best performing regions. A lot of really good entrepreneurs, a lot of stuff in infrastructure that's done well.
Will it keep being its best?
I think where you should watch, I think defense stocks are going to do well there. I think that financial services are going to do well, and watch some of the smaller tech companies. But over time, it's all about productivity. We've been saying that for years. Continue to focus on that. Happy to come back and beat the drum on that. So happy Friday to you all.
Look forward to seeing you again.
Okay.
Perfect wrap for the conversation, sir.
Sounds good.
You're a professional. Thank you. Henry McVey there of KKR. A range of issues to work through. That wall of money, though, is key.
And that's one reason why a lot of people, including Mike Wilson, who is colored as this huge bear on Wall Street, has actually turned really positive and says it's the early stages, as he was talking to you guys yesterday, of some sort of bull market.
The amount of money that's been invested right now, you were talking about that briefly, is unbelievable. A quote that stands out for me in the last 12 months or so came from the Alphabet CEO. The biggest risk right now for them is underinvesting and not over-investing. They see some of these themes, these trends, the technological advancements of the last several years, as an existential risk to their companies. And I think you see that not in the words, not just in the words of the Alphabet CEO, but also in the actions of the Meta CEO, Mark Zuckerberg, in the past few months.
And when you talk to executives across corporate America, it's not just the big tech CEOs that are talking about this. It's everyone. It's even the retailers. It's the fast food players. It's just this idea you need to be in on a game that is not going away.
The conversation continues on Bloomberg Surveillance. Coming up next, Dan Greenhaus of Solus Alternative Asset Management, Monica Guerra of Morgan Stanley, the SEC chair, Paul Atkins, and Saira Malik of Nuveen. The second hour of Bloomberg Surveillance is up next.
The underlying economy remains relatively strong.
There is pent-up demand in the economy.
There's a lot of fragmentation in this U.S. consumer right now.
Low-end consumer has been in trouble for quite some time.
I think we'll see that better read probably in August and September on really the true health of the consumer.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. The second hour of Bloomberg Surveillance starts right now, and your scores look like this. All-time highs heading into the weekend in the equity market at the moment. We're positive by not even 0.1%, just about unchanged on the Nasdaq 100. Later on this morning, 60 minutes from now, must-watch conversation. The Fed governor, Christopher Waller, on this program after making the argument for a 25 basis point rate reduction.
And a 25 basis point reduction this month, and that is out of consensus. He is one of two members. The other, Mickey Bowman, has suggested she'd be open to this. But if you listen to the rhetoric of a growing number of other Fed chairs, it also signals a potential openness to this type of rate cut, given the fact there hasn't been the same kind of growth in the labor market that many of them would like to see.
He is making a credible argument for lower interest rates, which will be music to the ears of this guy right here, the President of the United States, writing just moments ago, too late and the Fed are choking out the housing market with their high rates.
And the president saying that Jay Powell's one of his worst appointments. He's clearly frustrated. He's going after the renovations at the Fed. He continuously talks about how the rate needs to come down. But Jonathan, the words you used just there, credible. When you have Governor Waller coming out and listing the economic reasons why he thinks there should be a Fed rate cut, he is not only credible to the institution of the Fed, he's making arguments when he talks about tariffs being only a one-off increase in price levels. That's credibility to the economic advisors in the White House, and he's credible right now to the markets.
Consequences and risks. You've been focused on this for quite a while. Just to reflect on the 100 basis points of easing at the back end of last year and what happened at the long end of the curve when they did that. Yields went up, not down. Mortgage rates were higher, not lower. And that's going to be an interesting piece of the conversation later this morning.
To take a phrase that you've said quite a bit about other potential policy changes, the market has a vote. And this, to me, really is the ultimate question. Did we get a sense of what that vote would look like earlier this week when President Trump did suggest that he was ready to fire Powell, or at least that it was reported that he had drafted even a letter to do so? It just raises a question. Is the market in a place to understand that, yes, it is an appropriate time to cut rates by 50 basis points this year? And the answer is yes. That's the amazing thing. But how much more do you ultimately end up seeing?
The president talked about the fact, at least when I was in the Oval Office, about it was concepts of a plan of potentially firing Jay Powell, and he was spitfiring basically Republicans about potentially doing this. But asked yesterday, Governor Waller, he was asked, has Trump or anyone in the Trump administration asked you potentially to take that job? Nope. Next question. He doesn't want to be caught in the politics of this, and he's squarely focused on the economic reasoning behind his thesis of cutting Fed rates.
That specific question might be one we avoid a little bit later this morning. One-word answers aren't great for TV, are they? Just sort of nope. Move on.
Are you the shadow Fed chair? Nope. Have you talked to President Trump? Nope. Are you planning on being the next Fed chair?
Remember Chairman Powell in the news conference? Can you be fired?
Nope.
No.
Well, there you go. This sets off the battle. It is going to be an interesting point, though. Who is going to be watching this interview?
Bond yields this morning lower by 2 basis points on a 2-year. On a 10-year, we're down by 2 basis points to 4.43. Coming up this hour, Dan Greenhaus of Solus Alternative Asset Management as stocks set new highs. Monica Guerra of Morgan Stanley as Fed Chair Jay Powell addresses White House criticism, and SEC Chair Paul Atkins on a victory for the crypto industry. We begin this hour with stocks steady following a week of stronger than expected economic data. Dan Greenhaus of Solus Alternative Asset Management writing, certainly everyone thinks the coast is all clear, but I'd like to see the July and August data before drinking my own Kool-Aid. Dan joins us now for more. Dan, good morning.
Good morning to you, sir.
Do you like the data you've seen so far?
Yes, of course. And I think I tried to get the chart, but apparently we couldn't get it in time. But Anna Wong from Bloomberg Economics has a terrific chart showing the Bloomberg surprise indices.
I'll get Bobby in the control room to bring it up.
Jimmy, I think it was Jimmy. Who I have made famous despite not existing. But the point of the indices are that you see inflation surprise indices are obviously coming in less than expected. Growth indices are coming in above expectations. And I think more than anything else, that explains the situation in which we find ourselves. And when people ask TV, investors, whomever, why are equity markets at a high? Why are credit spreads as tight? That's as good an answer as anything that you could give.
The labour market's on the edge, according to Governor Waller on the FOMC. Do you think the labour market's on the edge?
I don't know if I'd say it's on the edge, but you've clearly seen a deceleration. He mentioned, his speech is, for those of us who've been talking about the likelihood of a rate cut while not positioning ourselves for Fed chair, although I would take the job, admittedly. Waller's speech is everything that we've been talking about, and he mentions how private sector job growth has decelerated. Last month, it printed in the double digits, and you want to be ahead of this weakness. And I think on the labor market front, that's a correct argument to make. I've been making it. I'm glad to see him doing so, and I think it's the correct one.
The ironic thing is that the committee believes in cutting rates by 50 basis points. That's the midpoint of the committee. Does it matter if they do it this month or if they do it in September? Does it matter if they do it one time or two times, if it's 50 basis points? How much of a consequence, to John's point, does this have for longer-term inflation?
I always appreciate you asking questions that you know the answer to. The answer is no. 1 month, 2 months, 3 months here or there doesn't matter.
I don't know. Maybe it matters tremendously to you, but carry on.
I don't think it matters.
Okay.
I'd be hard-pressed
They're
to believe
Lisa's
it.
favorites.
Well,
all right, let's move on.
But if the point is the direction of travel, so we know, I would argue that your over the next 12 months, let's say, is for 100 basis points of reductions to get yourself into the mid threes by next summer, something like that. That seems to me to be entirely justified. And in Waller's Q&A yesterday, he got asked about a long cycle, so to speak. So whenever you talk about interest rate reductions, it becomes 200, 300. His point in the Q&A was simply, let's just get the process started here. I think we're restrictive. We shouldn't be restrictive. And I think that's the argument I'm making. Again, I think you can get 4 reductions by next summer. But the point is that I think rates are too high at this point. You've seen some deceleration. I don't believe the tariff and inflation story, which he touched on. And so when you put that all together, the basis is there, the context is there for some rate reductions.
You talked a little bit about how there is no true political independence on the Federal Reserve, which is a pretty provocative statement, given that a lot of people have spent a lot of time, including myself, talking about what the loss of political independence would mean for the Fed and what kind of risk premium that would really charge on U.S. assets. Why do you reject this notion that this is even something that we should really be spending so much time on?
It's not that I reject that the central bank is independent, because clearly it is. What I reject is the idea that somehow it's completely devoid of politics. The chair is obviously appointed by the president. The board is appointed by the president, approved by the Senate. Famously, during the GFC, the Fed chair and the Treasury Secretary were having lunch every day, or at least once a week. That's a tradition that has continued, as I understand it. So my point is just, let's not live in a fairy tale land where politics plays no role. Do I think Jay Powell is holding rates steady and coercing the board to do so for politics? No, I don't. Do I think that politics plays a role in the central bank? Yes, I do. So, but within that context, I do hope, as all bank CEOs have articulated, and I imagine many people who sit in my seat have articulated, I do hope that the existing amount of central bank independence that we have persists. And I would point to the recent Supreme Court cases. There is a push for everyone in the executive branch to be answerable to the president, a view that I largely ascribe to. 2 court cases, Wilcox and Saira Law, obviously have played into this idea that the head of the Consumer Financial Protection Board, the FHFA, et cetera, are fireable by the president. But as many people know, that the Supreme Court seems to have carved out the Fed chair from that grouping, owing to its historical roots in the first and second Bank of the United States. I'm not sure if a case came to the United States that would hold up, came to the Supreme Court that would hold up, but at least for now, that seems to be in place.
To your point, though, on Fed independence, JP Morgan put out a note yesterday talking about the myth of this independence. And if Jay Powell is fired or stepped down, or even if we're thinking about just who Trump is going to appoint next, who do you think is actually credible, given the fact that we've seen people change their tone to really try to ingratiate themselves to what the president wants to see?
I don't think there's any doubt that the most credible of the people being discussed is Christopher Waller. He is known by the street. He was director of research at the Federal Reserve, became a governor, and was immediately thought of as a thought leader on the board, and correctly so, and remains today. He is, as I mentioned earlier, articulating the most cogent and, I would argue, accurate case for why rates can and should come down. I think if he was appointed Federal Reserve Chair next year, I don't think the street would have any problem with that at all.
So markets wouldn't push back, but what about the 2 Kevins?
I don't think the markets would push back per se. It's not as if it's not as if you're making the Hamburglar the head of the Federal Reserve. I mean, these are all qualified, credible individuals. Obviously, there's a political component to them varying up and down the spectrum. I don't think the market would necessarily freak out. Now, that said, if you were able to and successfully fire the Fed chair for the stated reason that interest rates should be lower, and someone came in and immediately cut by 50 or 75 basis points, we might be having a different conversation. But to the extent that a president of the United States wants lower interest rates, I don't think that's necessarily front page news.
This market has hardly blinked. In fact, when we had the reports out about the firing of the Fed chair all of these reports started to drop. He's got a letter. It's imminent. Markets barely moved. I thought that price action was really tame. And I found a lot of the price action to be very tame in the face of increasing threats coming from the White House. Why do you think that is?
Well, listen, the short term is algo-driven, so I will chalk any short-term move up to algorithms. But the truth is, in this conversation, the larger issue with respect to the central bank is not a minute, an hour move. It's what happens, to Lisa's insinuation earlier, what happens over time. How much extra compensation do investors demand for a central bank that they perceive to be less independent? That's worth 25, 50, whatever it might be, basis points over the long term, which ultimately increases borrowing costs for the United States. So I wouldn't look too much into that short-term move the other day and say, well, the curve steepened, the dollar sold off. I'm not saying they're illegitimate moves or incorrect moves. I just think this issue plays out over a much longer period of time than an hour.
And the answer is more. They want more compensation for holding U.S. assets.
And how much is this going to be expressed in the yield curve? How much is this going to be expressed through the currency channels? A lot of people saying the currency channels are going to bear the brunt of it, which is why the consensus right now, and the most crowded trade according to the last BAML survey, is short dollar.
Dan talked about qualifications. It's not about qualifications, it's about motives and perceived motives. The perception of the market of what the motives are of that individual. And if they come from within the White House, given the pressure that's being put on at the moment, clearly a lot of people in this market will perceive that individual as having motives that are distinct and divorced from where the economic data is, and ultimately they'll be following where the politics are going.
And given that the motives might be more political in certain cases than maybe economic, that would be the theory for markets, there would be a concern that it would allow inflation to pick up steam on the longer term, which is why people might be more reluctant to buy into longer term bonds. That is what people are looking for in terms of the vote from the market.
That was Lisa answering her own question from earlier, Dan. There you go.
No better question than the one you know the answer to.
Better than yours.
Come on.
Dan Greenhaus of Solus Alternative Asset Management. Dan, appreciate it. Thank you. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Lizzie Burden. Hey, Lizzie.
Hey, John. Shares of Chevron and Hess rising in the pre-market after they were cleared to move forward with a mega merger. An arbitration panel dismissed Exxon's attempt to block the deal. Exxon had claimed that it had a contractual right to bid for Hess's assets in Guyana. And elsewhere, the US House of Representatives passed a bill to create a first-ever regulatory framework for stablecoins. It introduced federal or state oversight of dollar-linked stablecoins to legitimize the market. The bill now awaits Senate consideration. And in sports, round 2 of the Open Championship is underway at Royal Portrush in Northern Ireland. 5 players from a record 5 countries tied for the lead at 4 under 67 in the tightest logjam since 1938. Top-ranked players remaining within striking distance include Scottie Scheffler, Phil Mickelson, Rory McIlroy and defending champion Xander Schauffele. That should be my brief, John.
Lizzie, thank you. Appreciate it. The Open Championship, not the British Open, the Open Championship. Get very sensitive about these things.
All I know is that this is what's going up on your YouTube feed. Just one clip after another of this. This is an entire
I've been very
weekend.
disciplined.
Oh, yeah? This morning.
There's nothing on the screen apart from markets. OK? Up next, scrutinising Fed renovations.
I think, again, this is a good use of taxpayers' time to look into this project that is millions and millions of dollars over budget. It's for a big, beautiful mansion for the federal chairman, reserve chairman.
Markets and drawings from architects. Up next, Monica Guerra of Morgan Stanley, live from New York City this morning. Good morning. Live from New York City, welcome to the programme. Just about unchanged this morning on the S&P 500 and on the Nasdaq. The focus down in Washington, D.C. is on this, scrutinising Fed renovations.
I don't believe there's a deadline the president has set for Rust Belt, but I think, again, this is a good use of taxpayers' time to look into this project that is millions and millions of dollars over budget. It's for a big, beautiful mansion for the federal chairman, reserve chairman. It's completely unnecessary. It's overpriced, and I think it's a good thing the administration, led by the president, is looking into it.
Here's the latest this morning. Fed Chair Jay Powell defending the Fed's renovation project, writing in a letter to the director of the Office of Management and Budget, "We take seriously the responsibility to be good stewards of public resources." Bloomberg's Mike Shepard joins us now for more. Shep, is this a serious pursuit or a distraction in the nation's capital?
Well, this is a serious pursuit because ultimately it's not just about the building renovation at issue in this letter that Jay Powell sent to the budget chief at the White House, Russ Vought. It's about interest rate policy and whether the Fed chair will actually bend to the president's will when it comes to lowering interest rates. We heard Donald Trump just in the past hour make yet another demand of Powell and the board to lower interest rates. There's a meeting coming up at the end of the month. The president is now linking the Fed's unwillingness to lower its benchmark rate to tightness in the housing market. And he's saying that real Americans are starting to feel this pain. And he is also pointing to what he sees as lower inflation, giving the Fed leeway to do so. And of course, he added in some of the typical insults that he has been hurling at Powell in recent weeks. We heard him call the Fed chair a knucklehead in the Oval Office the other day. Today, he added numbskull to add emphasis. But when it comes to the building, John, this is really what would be used potentially as grounds to oust the Fed chair if Donald Trump decided to actually follow through with that. They would need grounds to boot him out of office. They can't just fire him because they don't like his interest rate policy. The Fed is an independent body. The board votes on interest rates. It's not just the Fed chair. So they would have to find other grounds. And you have seen Trump and Republican allies using this as an argument gradually to undermine the Fed chair, but perhaps create an argument or grounds to maybe legally move against Powell if that comes to actually happen in coming weeks and months.
Attempting to build a legal case. Mike Shepard, thank you, sir. Down in Washington, let's talk about the economic case to lower interest rates. Governor Waller presented one yesterday evening. Others have said wait. And they've said wait because they want clarity on policy. And we haven't had that yet. And then once they've got the clarity on policy, they want to wait and see the pass-through to inflation, see how that builds in the next few months.
We've already gotten a hint, particularly in home goods and appliances, in terms of what the tariffs have done to inflation in those sectors. Whether it comes away at the expense of people spending elsewhere is sort of the key question, especially on the heels of yesterday's retail sales number that came in pretty hot.
That was decent. Jobless claims were lower. We've talked about softer PPI, softer CPI. Let's have this conversation now. Monica Guerra of Morgan Stanley joins us for more. Monica, good morning.
Good morning.
We've had exemptions, extensions. What is the effective tariff rate in this country now compared to where it was at the start of the year?
And now the estimate's around 15 to 12%, depending on how you're actually counting, which really is 5 times the average effective tariff rate on January 1. And so what we're really waiting for is this pass-through of inflationary impact. We've essentially been in this wait-and-see period where some folks are saying, see, the tariffs haven't really had any major implications. And you've outlined some of the positive data that we've seen come in. But we are starting to see some weakening and some cracks. The other thing I just want to mention is that, the dollar is actually down, about 10% from the beginning of the year. And so that plays another additional factor in this when we're thinking about the role of tariffs and the economy.
When it comes to the tariffs, Governor Waller making the case yesterday, they are a one-off increase in price levels. Do you agree?
Yes. We're looking at idiosyncratic sectoral industry-based tariffs, 100%. But when we're thinking about the universal tariff shift upward, you're going to get not just that one-time cost level shift, but then you have anticipatory cost pass-throughs, right? You have the consumer having a pull forward in demand. All of these things get the flow of money moving faster and push up on inflation. Then you throw into the equation the dynamic between a lower dollar and potential tariffs or higher tariff rates. That means that importers are going to have to actually pay more. It's going to be a much higher burden from them if the dollar is weaker against the goods that they're bringing in, which means potentially higher inflation for the consumer.
When it comes to the tariff negotiations right now, the president is talking about 10 to 15% for 150 countries or so. But they are in active negotiations with a handful of the U.S. biggest trading partners. When do you expect these deals to get done?
Well, we're supposed to have some clarity right on August 1st, but we've seen that continue to, kick the can. I do think we're going to get more deals in the coming weeks. And so, again, this is going to be a patchwork, and we have to see how it all pans out. Now, one of the other interesting things about this is that just because you're getting a universal tariff rate of 25% on Japan, only 50% of the goods that we'd be importing from them are going to be subject to that 25%, right? When we're thinking about the total burden to U.S. imports. So when we're thinking this through, you have to put that patchwork into effect and recognize that it's not just a country and regional specific risk, but then there's also sector and industry specific impacts because we're not going to be importing the same goods from Japan that we would from other countries, for example.
It's such a complicated picture, which is a reason why people are struggling to put it all together, not least of which is the Fed officials. This idea of who pays the tariffs is fascinating. In your discussion around the dollar, I really want to focus on how much does that allow companies to absorb more of the hit in their profit margins because they have such a competitive advantage overseas and might be gaining business overseas that actually leads back to higher profits based on the currency differential?
Yeah, that's a great question. So when we're thinking that through, you have to look at who has the highest percent of revenue exposure to foreign customers, foreign clients. And that's going to be tech. That's first out of the gate, as well as materials. And you're looking at, the materials, energy, and tech sectors as the potential winners with having that weaker dollar in this tariff game. Now, if we pivot and we look to domestic concentrated revenue bases, those are going to be the industries and sectors that are going to be the hardest hit because they're going to have to absorb those import costs at a much weaker dollar.
When you put all this together, it seems reasonable to sort of infer that this is going to be less of an impact than people might have believed at the outside of some of these tariff threats. What are you watching for that might indicate that there are prolonged inflationary forces at play here that could stretch more than just a couple of months?
And for us, we're looking at how the consumer is behaving. So as soon as people stop going out to eat, that's going to be your big red flag, right? Travel, has been sort of in flux, but positive overall. But usually it's travel and then restaurants. And if going out to eat is the first thing that goes, that's the biggest marker that people are starting to pull back and move home. The other thing I just want to emphasize here for us when we're thinking about how to position around this is not just looking to the potential winners, like a tech industry, for example, but keeping into account that we do still expect inflationary pressures. I think the debate is really around the magnitude. How bad could it be, like you mentioned, Lisa? And really making sure that you have a diversification across not just the inflationary hedges, right, real assets, alternatives, but also, looking for those winners as well.
Monica Guerra of Morgan Stanley. Monica, appreciate it. It feels like we're the frog being slowly boiled by all the tariff headlines, right? Well, before you know it, you're at 25% effective tariffs, just like that.
Because markets aren't pushing back because they're seeing all the different ways that it can be offset in different pieces. And then all of a sudden you're looking at this tariff load. And if we stop going out to eat, evidently that's a problem. I will say it's really expensive to go out to eat, especially when you add taxes and then tip, and it just becomes sort of
getting more and more expensive.
Isn't it? I mean, is it just me? I mean,
it's not just you.
It's just like hard to justify.
Just the hits keep coming.
I mean, and then ordering in and then delivery.
It's Friday. Come on.
Okay. Right,
don't cancel date night this early.
Lisa's not going out to eat this weekend. Up next on the programme, the chair of the SEC, Paul Atkins, as the House passes landmark stablecoin legislation. Plus, we'll catch up with Saira with your morning movers and a step forward for a mega crude merger. Making the case for lower rates 30 minutes away. We'll catch up with Governor Christopher Waller of the Federal Reserve, who yesterday here in New York City called for a 25 basis point reduction of Fed funds. Today, later this morning, he'll articulate why. We're hearing from the president. He's got this to say: lower the rate, too late. The hits keep coming. This pressure is unrelenting.
Yeah, talking about how President Trump saying that Jay Powell was one of his worst appointments ever, as he really does push him to lower rates. I assume that the argument, lower the rate too late, has less emphasis in markets than going through the labor market data and citing the beige book on 3 occasions.
Yeah, that doesn't work on social media, right?
If you look at the June 4th beige book.
We'll have a more sophisticated conversation hopefully later this morning. Equity futures right now on the S&P 500 just about unchanged. Likewise on the Nasdaq with your morning movers. Here's Saira. Morning, Saira.
Hi, John. We start with some major news in the oil space. Take a look at Chevron and Hess. Both shares are rising after Hess won its arbitration battle with ExxonMobil, clearing the way for Chevron's $53 billion takeover to finally move forward. The ruling ends months of uncertainty tied to Hess's valuable stake in the Guyana oil fields, which is one of the fastest growing oil areas in the world. So Chevron really needed this win in order to justify this deal. And here's another big winner from all the volatility we saw in the second quarter. Take a look at Interactive Brokers. Shares are up 5.5% after the online brokerage posted higher than expected profit and revenue as trading volume soared. Commission revenue jumped 27% thanks to more active users. And we end on 3M shares. They are also higher. It just reported results and it raised its profit forecast and beat Wall Street estimates, even while factoring in the impact of tariffs. Shares are up 2.5%. The maker of Post-it notes now expects earnings as high as $8 a share this year. That is 10 cents higher than the upper end of its previous forecast. But it's no accident. CEO William Brown, who is fairly new to the role, has been shifting production and pricing in order to blunt the impact from those tariffs. So another American company navigating these tariffs pretty well, John.
Yahara, thank you. Talking about corporate resilience over and over again. Savita Subramanian of Bank of America made that argument so many times. Don't underestimate corporate America.
They are right now finding a lot of pathways to absorb some of the costs and really just do fine. And a lot of this does have to do with what they're doing with technology. Really, I can't stress that enough. When I hear more and more about it, it really blows me away.
That's amazing. We'll get to more on tech in just a moment. On our radar this morning, Fed Chair Jay Powell responding to criticism of a $2.5 billion renovation project at the Federal Reserve. Powell writing to the White House, quote, "We take seriously the responsibility to be good stewards of public resources."
And you can go on the Fed webpage now and look at all the reasons why they say they need these renovations. Powell is denying in this letter, though, to the OMB director about VIP elevators. He defends the vegetated roofs. I think what stands out to me on the Fed website, and Lisa's laughing because it all has become a little bit dramatic and much, is that they say these buildings have not been comprehensively renovated since their construction in the 1930s. The bottom line is Powell's out defending this because the administration continues to attack. This is a new line attack. First, it was about you should be lowering interest rates. Now it's about that you're over budget when it comes to these renovations. And they're trying to, at least at minimum, undermine how the public feels about Fed Chair Jay Powell.
The pressure keeps coming. The president, again, pushing this morning for lower interest rates at the Federal Reserve. Lisa was talking about tech. I want to talk about Meta, continuing to build its artificial intelligence team. Sources telling us here at Bloomberg, the social media giant hired 2 more AI researchers from Apple after poaching their former boss from the iPhone maker.
It looks like Apple's a sitting duck. I mean, for absolutely everyone in terms of its talent, especially as it struggles to really get inroads on the AI story. This, though, speaks to the existential risk that not being at the forefront of technology is for the likes of Meta, for the likes of Google, for the likes of Microsoft. If you don't have the top talent, that could potentially sink you. That could own you later on. And that maybe is the reason why people are getting a little concerned about Apple, because they are losing this talent and they haven't made those inroads.
The Alphabet CEO several months ago, we said it in the last hour, the biggest risk is underinvesting and not overinvesting. And they see a lot of these themes as an existential risk.
The competition isn't just coming from the tech companies. It's also coming from across the stack, because every single company could potentially miss out if they aren't necessarily at the forefront of whatever trend the consumer is experiencing with the interface for each business. And that really is what you're hearing across corporate America.
Some of the biggest banks on Wall Street feeling insecure as well. Goldman Sachs taking another step to try and keep its interns and new employees away from competitors. According to a memo seen by Bloomberg, the bank is launching a program to offer applicants a path to the asset management unit, which has a private markets arm.
Evidently, the first one didn't work, which was loyalty pledges. So standing around being like, we promise, we will not accept a job. This is, okay, we'll try something else. We'll give you an opportunity to maybe have a similar type of job, and that could potentially be the right approach.
To the bank's defense, although the loyalty test was so interesting, it reminded me of what actually the Trump administration was doing, I pledge allegiance to the Goldman Sachs. Anyway, what the banks are saying to their defense is we go out, we spend a tremendous amount of money going out, finding talent. We're the ones that are making sure these individuals are trained. We want to keep them in-house. So that now they have a pathway.
That's the latest on Wall Street. We've got a special guest, so let's get to him. Congress passing the first federal legislation to regulate stable coins in a major win for the crypto market. Joining us now, I'm really pleased to say, for a first time here on Bloomberg TV, on Bloomberg Surveillance, the SEC chairman, Paul Atkins. Chair Atkins, welcome to the program, sir. It's good to see you.
Good to see you. Thank you very much for having me.
Well, thank you for being here. Before we get into it, I wanted to offer you the opportunity, sir, to talk about your philosophy in this seat versus what came before you and the difference maybe between deregulation and just innovation.
Well, thank you very much. We are out to, obviously change direction at the SEC, and I think we've already done that here in my first 2.5 or so months at the agency. But we're moving away from regulation through enforcement and uncertainty in the markets, especially with respect to cryptocurrencies and digital assets in general. And we're looking to set firm, clear rules of the road for people who are operating in that environment so that innovators can innovate. They can rely on their advisors to tell them, which is the right direction and how they can build on solid ground.
Regulators, though, can't step in without explicit action from Congress. So when it comes to cryptocurrencies and the SEC, what actually comes next? What are your plans?
Well, so even before I got to the SEC, Hester Peirce, who's one of the commissioners, and she used to be my counsel when I was a commissioner back in 2002 to 2008, was in charge of a crypto task force that we're calling it, and they are focusing on making clear rules for the industry. So, for example, things like meme coins and stable coins that was just the subject of the bill that was passed yesterday are not securities, and before that was not necessarily clear. And so that's an example of how we're trying to put people at ease in the marketplace so that they can innovate and they can move forward with their plans and not have to look over their shoulder.
When you were talking to reporters yesterday after the passing of this legislation, I believe you'll be at the White House today with the president when he signs it, you said the SEC is considering a, quote, innovative exemption from regulations to incentivize tokenization. What does that exactly mean, innovative exemption, and how long does this process take?
Well, it'll be an iterative process, and right now we are working on setting forth different things that can, again, make it clear for people in the marketplace, which way is the true north for them, let's just say, so that they don't have to worry about falling off the ditch and, falling into the ditch and getting in trouble with the regulators. And so part of that will be working with our colleagues at the other regulators, and especially the Commodity Futures Trading Commission. But let's just say that as we go forth and as we interact with the marketplace, we've had 5 roundtables now looking at various aspects of the digital asset space. So we are working hard at coming up with guidance and rules, and we'll use every tool in our toolbox to help people understand what is, how to stay out of trouble, basically.
Chair Atkins, one of the big concern is that a number of the stablecoin issuers are not going to have the sufficient number of hard currency reserves on hand to really back those notes in a way that is as advertised. How are you prepared to really counter that? Is that something that's in your list of concerns that the SEC is going to be monitoring?
Well, one thing that I think the new to-be-signed bill into law makes clear is that these are not securities, and it's the banking regulators who are going to be looking after them. And I think that's appropriate because of the role that stablecoins play, and I think will play in the future. Because part of the real promise, I think, of distributed ledger technology is immediate payment as part of the process of transactions. So settlement coming down to, in effect, almost T+0, and to do it on the trade date. And that will make things much more efficient in the marketplace, save money, reduce risk in our financial system. So stablecoins are in the realm of the bank regulators, and they will look after to make sure that there is adequate and as advertised adequate backing to the stablecoins.
Chair Atkins, just sort of switching gears a little bit, there's been a lot of discussion around Congress and the president passing legislation that would open the door for people to take their money from the 401ks and put it into private assets, in particular private equity. How do you plan to oversee and make sure that that's done in a way that isn't potentially punitive for people who are retiring at ages where they need a lot more money for a lot longer?
Well, on that issue, we've heard a lot of input from both the investors who want access to the private markets and to those sorts of products, and obviously from the people who are producing the products who are out to meet that demand. So, but we have to do it carefully, I think, because, of course, the private markets are a lot different than the public markets. Their liquidity is not the same. There are all sorts of things for people who are not aware of the rules of the road where they could get hurt. And so we will work very closely with our counterparts at the Department of Labor who have oversight over ERISA accounts to make sure that, that we have appropriate guidelines around these various products. And they're really for, of course, long-term investment, especially private equity and things like that. So we have to do this in a smart way so that individual investors are not inadvertently into something that they didn't realize what they were getting into.
Well, speaking of 401k retirement plans, would you allow crypto into retirement plans? Because the Financial Times is reporting that we could see an executive order from the administration as soon as today allowing alternative investments into retirement plans.
Well, again, I think that, disclosure is key and that people need to know what they're getting into. So things like that are not for everybody. And so especially in retirement plans. So I look forward to whatever may come out from the president as far as direction goes. But we need to address it because there is a demand out there for these sorts of products, and the government should not stand as a blocking agent for those sorts of things. But we need to enable it in the proper way with proper guidelines and proper disclosures.
Chair Atkins, you run an independent agency. So does Jay Powell. I would love to know, are you under any pressure from this White House? And what would be your advice to Jay Powell? Because it seems like you have a better relationship with President Trump.
Well, I think, so I've been at the SEC now. This is the third time. I was there in the early 90s under Richard Breeden and Arthur Levitt, and then again from 02 to 08, and now here in 2025. So, frankly, I don't see really any difference in operation from back then to now. I know there's been a lot of coverage of that, but, we are working hand in glove with our counterparts in the administration and at the Office of Management and Budget and OIRA as far as talking to them about rules and other things that we are going to be publishing. So, keeping them up to date, taking their comments, which are all very good. So I don't see any real difference, frankly, in the ambit of maneuver that we have at the agency. So I look forward to achieving a lot with in the time that we have, and because there is so much to do. This is what I like to call deferred maintenance that we have to address, and so we are moving, I think, at a very quick pace, and so the rest of this year, I think, we'll be churning things out and moving in a different direction.
Hopefully this is a start of an ongoing conversation. Appreciate your time, Chair Atkins. Thank you, sir. The SEC Chair, Paul Atkins there, down in Washington, D.C. Brilliant question at the end there, addressed by the SEC Chair.
Well, he says that he has this relationship that he's had even back in the day when he used to run the SEC, the same as in the White House, doesn't feel like he's under any sort of pressure. Obviously, the SEC is an independent agency, just like the Fed is, but Jay Powell is getting bamboozled every single day. 2 truths just today alone. You haven't seen that kind of treatment of Paul Atkins.
The pressure keeps coming. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Let's cross over to Lizzie Burden. Hey, Lizzie.
Hey, John. American Express second quarter earnings beat estimates buoyed by its premium clients. The company's CEO said it saw record card member spending and rising demand for its premium products. Amex affirmed its full-year revenue growth forecast of 8 to 10%. And elsewhere, Wells Fargo suspended travel to China after one of its top trade financing bankers was blocked from leaving the country. Sources telling us here at Bloomberg, an Atlanta-based managing director who was born in Shanghai was banned from leaving the country. Wells Fargo said they're working on bringing their employee back to the United States. And WNBA All-Star Weekend kicks off tonight in Indianapolis without its star. Indiana Fever's Caitlin Clark has announced she will not be participating in any of the events after suffering a right groin injury on Tuesday. Clark has already missed 11 games this season due to injury. And that's your Bloomberg Brief. John.
Spent the year beating her up. Lizzie, thank you. It's brutal watching WNBA. Seen some of those hits?
Yeah, they're pretty wild. And she was painted as sort of this bad character for getting angry about some of the stuff. I have a real soft spot for her. People find her controversial. She has single-handedly brought this entire sport up.
Couldn't agree more. Got to protect your stars.
100%.
Haven't protected that star. Up next on the program, the beginning of a new bull market.
I'm hoping we get a pullback to some degree. This is what the beginning of a new bull market looks like, right? It's just explosive. It doesn't let people in, but I really can't see more than a 5 or 10% correction given what I see now in the landscape.
Up next, Saira Malik of Nuveen, live from New York City. You're watching Bloomberg TV. This week, so far, so good. Data's been okay. Downside surprise on CPI, on PPI, retail sales decent, jobless claims better, earnings from the big banks on Wall Street pretty firm. Equity market at all-time highs. Is there some fragility building beneath the surface, particularly in the labour market? That's an argument, a debate we'll have on this programme in about 10 minutes' time with Chris Waller, the governor of the Federal Reserve. Look out for that conversation at the top of the hour. In equities right now, S&P 500 futures positive by not even 0.1%. Under surveillance this morning, the beginning of a new bull market.
I'm hoping we get a pullback to some degree. I think a lot of clients are looking for a pullback of some kind. This is what the beginning of a new bull market looks like, right? It's just explosive. It doesn't let people in, right? The rate of change is accelerating beyond what you expected. So it's just, I think the pullbacks will be short and shallow. Maybe there'll be another surprise, another test of some kind that will cause something more severe.
Here's the latest this morning. Upbeat earnings and growing confidence in the U.S. economy driving the S&P 500 and the Nasdaq to fresh all-time highs. Saira Malik of Nuveen writing, expect beat and raises in the second quarter. Saira joins us now for more. Saira, welcome back to the program. I want to get to a line from Mike Wilson of Morgan Stanley. He believes that this is what the beginning of a new bull market looks like. Do you agree?
Well, I would say that we're in the middle of a bull market. I think it has been around for quite a while, but it has legs to continue for two reasons, and that's the economy and strong earnings. Now, there's also a bit of volatility we need to think about, and that's because of the drama around the Fed chair position. But going back to earnings, which is what you mentioned, earnings, the bar is low this quarter. We're expecting consensus is expecting 4% revenue growth, 5% earnings growth. If you look at history, revenues tend to grow about 7%, earnings at 10%. That's a setup for companies to beat and raise guidance. And we think that's what you're going to see. And that's what's going to drive the markets higher in the short term.
That's what we got from some banks this week. JP Morgan, a good example of that. JP Morgan came out with a beat and a raise. The bar for them seemed to be higher than for others. So when you say the bar is low, in what sectors, in what kind of companies?
Well, earnings always starts off with banks and they set the tone. And you're right, banks had a nice rally year to date. They had outperformed versus the S&P 500. So the bar was high for them. We still are seeing strong earnings even today from companies like American Express. But the leader of earnings historically in the U.S. is technology companies. So that's what we need to count on for this cycle. They've led about 2/3 of earnings growth in the past, and they're over 30% of the S&P 500 as a sector. I think technology companies driven by artificial intelligence is going to be where you get your earnings growth this quarter. And that's what's going to make or break this earnings cycle.
That's on the one hand. There is this feeling that companies are doing really well and that they are exceeding expectations. I am wondering how the rate picture fits in, how susceptible they are to some sort of increase in the yield on the long end that could potentially disrupt the story.
Well, first of all, the initial drama around obviously interest rates and what's going to happen has a bit to do with the turmoil around the Fed chair position. Second of all is when will the Fed cut interest rates? Our expectation has been that the Fed will cut rates 2 times this year, starting most likely in September. They'll do that because there are some signs that the economy is slowing, but more importantly, there's signs that inflation is becoming more benign. And so I think that's going to be what the market relies on in terms of optimism over Fed rate cuts. But we do have to worry, like we did around Liberation Day, about the longer end of the curve and what's happening there. But as of right now, things have calmed down in that area.
Have you been surprised, Sarah, that we haven't seen more disruption in markets, in particular in equity markets, from the whole discussion around Fed independence?
Well, I think that markets in the end trade on fundamentals and earnings season, and we've had historically beat and raises for each earnings season. Part of that has happened because consensus has declined as we've approached earnings season. If you go back to first quarter earnings at the beginning of the year, markets expected 12% earnings growth in the first quarter. By the time we got to that earnings season, consensus was at 6%. Now, as I mentioned, it's at 5% for earnings growth. So the setup is there to beat, and that's usually what markets trade on. Now, the other side of that is the valuation argument, and I think that one is real. Markets are trading at a premium, and they need to be able to deliver these earnings driven by technology companies to support the premium valuations of the market.
Sarah, how dependent do you think your call is on lower interest rates? Is this a market that needs rate reductions?
It's a market that would like rate reductions, and the risk around it is that if the Fed waits for the employment market to crack, usually the employment markets crack when a recession starts. So that would put the Fed behind the curve. And I think that's a real fear for the markets is, are we going to be too late with rate cuts when a recession already starts? Now, on the other side of that, I don't think a recession is imminent. We saw that this week with strong retail sales. We're going to hear companies like American Express talking about how consumers are still spending. But we need to be careful of some of these cracks. In inflation data this week, both CPI and PPI showed that consumers are becoming more sensitive to the services and entertainment spending like airfares and hotels, and that goods prices are increasing. So I think those rate cuts would help. We're not dependent on them, but we are concerned that the Fed may wait too long if they're looking for that real crack in the employment market.
You're not alone. Sarah Malik there of Nuveen. Sarah, thank you. This is something we'll hear in 5 minutes' time when we speak to Governor Chris Waller. We no longer have the luxury of waiting.
And he's really finding company on the committee, in particular Mary Daly, who said that she doesn't want to see the labor market soften any further. The idea that Sarah raised, that once you start seeing the cracks, it's too late, because usually that already signals a recession.
We've got a big hour coming up. The third hour of Bloomberg Surveillance just around the corner. Coming up, Fed Governor Chris Waller, Dan Ives of Wedbush, Sarah House of Wells Fargo, and Sonal Desai of Franklin Templeton. From New York City, you're watching Bloomberg TV.
As long as there's cash in people's pockets and FOMO, markets are going to continue to grind.
The tailwinds for the market is basically the speculative frenzy that is going on right now.
A lot of what the issues are that could result in a repricing, they're all out there. The question is, are the markets reflecting that?
The market is expecting lower rates. This is what the beginning of a new bull market looks like.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Mike Wilson and Morgan Stanley bullish, big time. The start of a new bull market. Live from New York City this morning. Good morning, good morning. The third hour of Bloomberg Surveillance starts right now. Going into the weekend at all-time highs on the S&P 500. Your scores look like this. Futures positive once again, up 0.1% on the S&P and on the NASDAQ.
Yeah, a company is showing how well they are adapting and adjusting and then some beating. Maybe the bar is low given the fact that you haven't expected this kind of strength. But nonetheless, they're beating across all sorts of metrics and people still don't seem that impressed. I mean, the fact that we're at all-time highs, great. But the earnings so far have been pretty awesome relative to expectations, and a number of those shares are lower.
It's Friday. If it's Thursday, Wednesday, Tuesday, Monday, you know what happens. The president's out there once again calling for, guess what? Lower interest rates. The president already making the case earlier this morning.
Two truths already this morning. The last one saying lower the rate, too late meaning Jay Powell. He continuously is going after the Federal Reserve for lowering interest rates. And we're going to be speaking to someone who actually also agrees with the president, but for economic reasons. And one of the things Governor Waller said yesterday really goes to this idea that everyone's been talking about the uncertainty of tariffs. And he says tariffs are a one-off increase in price levels, which is what gives him credibility in this race to be the next Fed chair. inside the White House, inside the institution of the Fed, but also most importantly to financial markets.
If you are just joining us, welcome to the program. Futures just about positive on the S&P 500. A big 60 minutes coming up here on Bloomberg TV. We'll be joined by the Fed Governor Chris Waller, calling for a rate cut this month. We'll catch up with Dan Ives of Wedbush as big tech pushes stocks to record highs, and Saira House of Wells Fargo on the state of the U.S. consumer. We begin this hour with our top story, making the case for a rate cut. Fed Governor Chris Waller telling an audience here in New York, looking across the soft and hard data, I get a picture of a labour market on the edge. Joining us now here in New York City, the Federal Reserve Governor, Chris Waller. Governor Waller, good morning.
Oh, good morning, Jonathan, Lisa, Annmarie. Nice to be here.
It's good to see you, sir. Let's talk about why we're losing the luxury of waiting. Have we lost that already?
No, I think we haven't. Like I said last night, the headline numbers for the labor market, what we're seeing are okay, but it's like when you get underneath and start looking at the data, the private sector is not doing as well as everybody thinks it is. Like half of the employment growth we saw last month was in the public sector, and that means the private sector is not doing particularly well. So I was just joking that, if you're walking on a lake and the ice is frozen and it sounds safe, but when you start hearing cracks, and that's what I feel like, it's too late once you go through the ice. So you've got to start prepping in advance before you have that happen.
How do you square that with what we've heard from corporate America so far? What corporate America has told Lisa, sitting down with Scott Kirby of United Airlines, talking about a rebound in the second half. What we've heard from the big banks so far this week. How do you square what you're seeing in the data with what we're hearing from CEOs?
Yeah, I mean, when I talk to CEOs, I get the same thing. We're in just hold pattern in terms of certainly the labor market. They're not hiring, they're not firing, they're just watching. And that's kind of what you see in this underlying private sector data. There's not much happening. So it wouldn't take much to sort of tip it. Now, could I be wrong? Absolutely. I mean, last year we got a couple of weak labor market reports that led us to cut in September, and then everything kind of reversed and went back up. So I'm not saying that couldn't happen again, but it's just we've constantly seen little bits of data continually coming down. The Beige Book yesterday came out. Some other stuff that we get out of the JOLTS, quits rates, hiring rates. These things are not indicating a super healthy private sector labor market.
As you know, you're facing potentially, and I stress potentially, negative supply shocks on both sides of the mandate. I want to sit on the labour market just for one further note. Immigration. How are you thinking about that when you look at a labour market at the moment, when we have people coming on the programme, on Bloomberg Surveillance, on Bloomberg TV, every single morning, 6 till 9, coming on here and saying, look at the data, unemployment could stay at these levels even with job gains of 50 to 100,000 because of tighter immigration. How does that factor into your thinking as you look at the US labour market?
Well, yeah, the labor market doesn't necessarily have to be affected by it because if workers flow in and they get jobs at roughly the same rate as the existing workers, the unemployment rate doesn't change even though the labor force is higher. And when they go back out, the same thing happens. If they leave the employment and leave the labor force, you don't see a big change in the inflation rate. Now, it can potentially affect the break-even rate that you would need to have the market going well. And that's what we're still trying to kind of get a sense of, because you basically brought 5 years of immigration forward. And, of that 8 or 9 million, most of them haven't disappeared. So they're still here somewhere. And whether they're going to work, they're not going to work, but they're still here. Where I think the immigration stuff, if immigration was a big factor, you'd be seeing shortages, and you might see some in, some industries. But like I pointed out, that if you look at the new college graduate unemployment rate, it's 7%. It's much higher than it has. These are not jobs that are being opened up because immigrants are not coming in. It should be just the opposite. If immigrants are leaving and these jobs are open, then the unemployment rate should go the other way. So that unemployment rate to me is telling me immigration is not the source of the problem. Firms are just holding off on hiring decisions. Even if their earnings are doing well. That's just what I'm saying they're doing on the labor side.
I wanted to say there's a mutual friend of ours that feels like he's missing out this morning, so he wanted to catch up with you as well.
He's out in Victor, Idaho.
He's having a good time, isn't he? Mike McKee joins us now. Good morning, Mike.
Good morning, John, and good morning, Governor Waller. I would say I'm sorry I'm not there with you, but I bet you're sorry you're not here with me. I know
you got it. I've been there before. It's a nice place.
You've made the case now a couple of times for a July rate cut, but how committed are you? Are you willing to dissent at this meeting if the majority votes the other way?
Well, I never want to commit to an action before the meeting. Otherwise, if everybody committed before, you don't even need to have the meeting to have a discussion. So the goal is to always go to the meeting, sit down, listen to all sides. People will try to convince me of their view. I'll try to convince them of my views. And in the end of the day, you make a decision on what you think is the right outcome and the right data, how the data is coming in. And right now, I laid out my case last night. I don't think I could be any more clear, I hope, as to what my position is and why I think we need to do this. It's just how I read the data and how I think about going forward, how you respond to anything that involves tariffs.
There's a lot of politics in this decision coming up, more than usual. And I'm wondering, Governor Bowman has also suggested she would prefer a rate cut in July. If two of you vote for a rate cut, if two of you were to dissent, would you worry about the market reaction to that?
You know, one of the things that has always bothered me since I took this job is the criticism that we are nothing but groupthink. All the meetings are the same. Nobody dissents. Nobody does anything. And I think this is healthy. I think this is a turning point in the way we want to think about policy. Some people don't want to cut, some do want to cut, but coming out and making the case either side, that's good, healthy debate. Otherwise, if we're always going to do the same, the joke is, why don't you just have one person set policy and send the other 18 FOMC members home? So this is healthy. I think this is what you want to see in a democracy. You want to see policymakers have serious, open discussion about where policy should go. It doesn't mean anything about politics or anything else. It's make the economic argument and then see if you can convince others to go along with you. And that's all I'm trying to do.
We totally agree with you, for the record. We were sick of the groupthink, and it's good to have dissent.
Yeah.
Mike essentially is asking if you will dissent at the end of this month. Is there value in dissenting on the FOMC?
Well, I mean, it's often the case that you dissent if you make it very clear you think at this moment in time this is an important thing to do. If you were to go in and do kind of a jihadist, I'm going to dissent at every single meeting no matter what happens, then you don't even have to show up. Everybody knows what you're going to do. So it is important to make sure that if you dissent, you do it carefully and you have the right reasons, and it's not going to turn into a serial dissenting potential case. I mean, that's how I take my job seriously and responsibly. So I only would think about doing this. I dissented on the balance sheet slowdown earlier this year because I felt like that was not needed. And that's kind of the situation we're in now.
Chris, if you do cut, the markets will go one way. If you don't, they'll go another, perhaps. How critical is it to get to a rate cut fairly quickly? You've mentioned the danger to the labor market, but if you do wait till September, is that going to be too late?
Well, that's kind of the debate. What does it mean to wait 6 weeks? Is it that critical? And the answer is probably not. It could be, but it's also the reverse. Why wait till September if it's just 6 weeks? That's exactly the thing. It doesn't kind of matter. Just start thinking about, do I want to wait and risk something happening? This is what we saw last summer, by the way. We left July, we left rates, and then boom, we got a very weak, bad labor market report. The unemployment rate jumped 0.2. Payrolls went way down from where they were, and people were screaming at us last August, you guys should have cut in July. So 1 month it always is 1 month. Just remember that, it's just 1 month. But we live in a world in which we have to respond to real-time data to kind of sense of where the economy is going. And I've always said, if you worry about long and variable lags, which everybody always talks about, the whole point of that is to get ahead of it, not wait for it to happen, and then take a policy action that takes quarters or months down the road to actually have any impact.
The new worry is tariffs. We've just had a 6-minute conversation with you about monetary policy. You've built a case for lower interest rates, and no one's talked about trade or inflation. 2 assumptions in your speech yesterday, and I think they're important assumptions. A large share of tariff increases won't be passed through to consumers. Any increase would fade over the next year or so. What data underpins that conclusion?
Well, one, it's just economic theory. So you put on a tariff, as long as it's a one-time tariff and that's it, that's a one-time price effect. I mean, this is economic theory. You could not get in any serious economic model persistent inflation from that. You would have to cook up some other amplification mechanisms, and that's what people talk about. Wages will start going up and everything will get out of control. You're not seeing that at all. This is just not, those kind of amplification mechanisms or wage price spirals aren't happening. Tariffs are a tax. And in public finance, you learn that you may levy a tax on a firm, but who bears the incidence or the burden of that tax? It can be a group of people or one person, not necessarily the firm. So this is what I've heard from a lot of firms. If there's a 10% tax, they'll force their suppliers to eat some of that cost. Workers may eat some of that cost in terms of less hiring and things like that. The firm will take it out of their profit margins. And then lastly, some of it will get passed on. And as I mentioned last night, I've heard this for months now. Like the rule is 10%, it's roughly, rule of thumb is a third, a third, a third. Suppliers will eat a third, firms will eat a third, consumers are going to eat a third of that tariff. So if you eat a third of it and it's 10%, like I've been arguing, this is like 3/10 of a, 3/10 on the inflation rate for a few months, and that's it. And it'll persist if you do 12-month over 12-month. That base effect will not go away for a while, and then it'll just drop off a cliff. So that's why I've been arguing you want to look at like 3 months and 6 months to see if these tariff effects pop up and then go away. And so that's more critical than looking at 12 months.
Yes, but the way the president is putting these tariffs on might not match up with theory, Chris. The Smoot-Hawley tax was passed and came into effect on a certain date. The president is not yet put on most of these tariffs. They're in theory still coming, and we still haven't seen the Section 232 tariffs for the most part, the national defense tariffs that he wants to put on semiconductors and pharmaceuticals, et cetera. So if the process is stretched out, consumers could be hit by an ongoing series of tariff increases, and given what they've just been through, isn't there a danger that inflation psychology starts to seep in?
Well, that's exactly the point. All my examples, Ben, is if you put the 10% uniform tariff on and keep it roughly in that range, then what I've described is what will happen. If there's constantly a sequence of higher and higher and higher tariffs, then you are going to get this rolling potential impact on prices. That's true. If it's still just a question of delaying it, that doesn't change my argument. Whether you see the spike in July or it happens in June or August or September, when it happens is irrelevant for the economics. That's a non-starter of an argument. Firms could also just spread it out in smaller increments over several months. The total effect still ends up being the same. They just get there in a later fashion, and it'll be smaller amounts. So the bigger thing is if we just continually get another wave of tariffs, another wave of tariffs, another waves of tariffs, that's when things become more problematic, thinking about what's going to happen with inflation.
You don't think the Federal Reserve should wait? I just want to talk about the experience of last year. I think Lisa's done a fantastic job of covering this over the last 6, 7, 8 months. The move we saw last year, 100 basis point reduction in interest rates on Fed funds, and then we saw a corresponding move of 100 basis points higher at the long end of the yield curve. Yields down did not happen. It was yields up and mortgage costs up as well. How do you think one informed the other? And how might that shape your approach to cutting interest rates this time around?
Well, I think last September there was a lot of, remember, the long-term rates were going down through August and early September. This was not any contradiction in what we were doing. It's just after the September meeting, the data just came back in the opposite way. Growth was up, productivity was up, employment suddenly took back off. And then you have real growth expectations being much higher. We were seeing productivity growth and GDP growth of close to 3%. So in that case, long rates go up anyway. So it's not necessarily there was some counter reaction to what we were doing. I never saw inflation expectations adjust that caused all this.
You don't think it was the market questioning your commitment to the inflation mandate?
If it would have been, you'd have seen it in inflation expectations in the market, not the Michigan thing. But we didn't see it. I mean, inflation expectations stayed fairly anchored all through this rise. So I think the increase in the long rate was just all the data was coming in for a better, stronger economy than we thought it was going to be in September. That's fine with me. You know, sometimes you're going to do these things taking a shot that I want to make sure we don't have a hard landing. And as I said, with any kind of an insurance cut, sometimes you don't need the insurance. It didn't work out. But that doesn't mean you go back and say, oh, that was a stupid decision to make.
Market-based expectations of inflation. Let's sit on this. There are clear and obvious threats to the central bank's independence right now. Every single day on this programme, we're quoting the president, calling the chairman too late and going after lower interest rates. And I think a way that you and I can have this conversation without addressing those those calls directly is to think about what's happening with inflation expectations. Do these threats threaten to de-anchor market-based inflation expectations? And is that something you and the committee might become increasingly sensitive to in the months to come?
Well, like I said, I look at the, after the tariffs came on, everybody was worried about de-anchoring expectations, particularly after some of these Michigan surveys came out. But when I always look at the market-based expectation, because people have money in the game. Firms are making decisions on what their chief economists are saying. And if those things are wrong, they're going to lose a lot of money. So I've always paid more attention. I haven't seen much in the way of market expectations being unanchored in any ways you want to measure them, any forward. Now, in the near term, of course, they might go up because you would see inflation in the short term. But in the longer term ones, I'm not seeing it. So either the market is just dismissing all of this as chatter and noise, or at some point, if something happens such that it becomes much more serious, then you might see a discrete jump. And then, that's going to be a problem for everybody.
One of the questions that we get all the time, Chris, from people on Wall Street or one of the posits they make is that all this criticism of the Fed is hurting Fed credibility, and that the next chairman's going to have a tough job because there are going to be expectations for the next chairman set by the White House rather than by the economy. Do you feel that inside the building?
No, to be absolutely honest, we just do our job every day. I go in, I just focus on my work on monetary policy, payments, and oversight of the reserve banks. That's what I do. I let this stuff go and then just try to focus on my job. And I think that's how all of us are proceeding with this. I mean, at the end of the day, the president, whoever they choose, you're going to have somebody that has credibility with the markets, or you will see, as Jonathan was just talking about, you're going to see inflation expectations spike. You will not get lower interest rates. You will get higher interest rates. This is well known. We've seen this everywhere around the world when this happens. And I know Scott Bessent knows this. So this is not something that is lost on anybody.
You've been nominated by this president for the seat on the board.
Yes.
You were previously director of research for Jim Bullard way back then. Is it a position you would like? Is it something you would like to do in the future?
Look, in 2019, the president contacted me and said, would you serve? And I said yes. If the president contacted me and said, I want you to serve, I would do it. But he's not contacting me.
And we'll see if he does.
If he says, Chris, I want you to do the job, I'll say yes. But he's not talking to me, so that's it. It's a hypothetical
that might change, relevant. Sir. It's good to see you. We appreciate your time.
All right, thanks.
You've been very generous with it. Thank you very much. The Federal Reserve Governor there, Christopher Waller. Mike McKee, thanks as well to you, sir, as always. Up next on the programme, we'll get you some morning calls, plus we'll catch up with Dan Ives of Wedbush, and we'll break down this conversation we've just had around this table, the case for lower interest rates.
The headline numbers for the labor market, what we're seeing are okay, but it's like when you get underneath and start looking at the data, the private sector is not doing as well as everybody thinks it is. If you're walking on a lake and the ice is frozen and it sounds safe, but when you start hearing cracks, and that's what I feel like, it's too late once you go through the ice.
Federal Reserve Governor Chris Waller on this programme just moments ago. Lisa, making the case for lower interest rates.
Yeah, saying that you have to do it before it's too late, making the case that we've heard a lot. I mean, too late has taken on a new meaning now, of course. There is this question whether he's going to descend. It sounds like he will descend. And he really raised the point. This is actually good. You want dissent. We're at a turning point in the economy, and that's typically when you do have countering views.
Really refreshing. He talked about there should be debate amongst policymakers. There should not be this groupthink, which is something most people on Wall Street, this administration, completely agree with when it comes to whether or not he would be the next Fed chair. He said the president has not reached out to him, but the president did reach out to him to join the board. And if he was asked to be the Fed chair, he would serve.
These 2 points that he made this morning and last night here in New York City on tariffs, and this is the key argument that he's going to have to confront the rest of the FOMC with, that a large share of tariff increases won't be passed through to consumers. And if they are, that increase will fade over time. And it's something we should look through. Point one, on inflation. Point two, and I think this is going to be maybe a little bit easier to get across to the rest of the committee. We can't keep going around saying the economy's solid and we have the luxury of waiting. because you've got an individual there that's saying, we don't. And I think he's got some friends, he's got some company on that point on the committee.
It isn't just Mickey Bowman, it's also Mary Daly. And she said it really would not be a good thing to see the labor market deteriorate more greatly than it has already. You're also seeing Neil Dutta, you're seeing others talking about how the private payrolls just really hasn't picked up. And one thing that Governor Waller mentioned was the beige book. And I know that we joke about the beige book being really boring, but it actually is really important because what it highlights is that almost every single district shows a weakening in the labor conditions and a weakening in the belief of labor conditions going forward. And that, I think, is getting their attention.
He talked about tariffs as a tax, but he talked about how it's really divided amongst the supply chain. So that tax, when it hits a consumer, is only about a third. He said constant sequencing of tariffs, continuously ratcheting it up, not 10, 15%. That could potentially be a problem. But how difficult is it going to be when you have a Fed governor that has a tremendous amount of credibility coming on the program saying that tariffs are only a one-off increase in price levels? Then the Fed chair might come out and say, well, we can't move because we don't know the tariff rates. Well, here's an individual saying we should be moving and the tariff rates don't matter.
It's a credible argument for lower interest rates, which might find some company on the committee. And for that reason, he's going to find it easier to engineer the kind of low rates that the administration would quite like. You go with someone from outside of the building, you've got a much, much bigger problem. If this market perceived, and it is an if this market perceives them just to be a political puppet and someone without the credibility.
If they're lowering rates simply because they're doing so in response to the president, that's going to lead to inflation expectations becoming unmoored. And you'd see that in market pricing, not the University of Michigan thing, as Governor Waller said. And that seems to be what his argument was this morning.
Don't we get the University of Michigan thing later
We
this morning?
do. We get a University of Michigan thing. And actually, it's been doing better. But a lot of people dismiss it.
Sounds like Governor Waller doesn't open that one.
Up next on the programme, we'll catch up with Sarah House of Wells Fargo on the state of the consumer. Plus, we'll speak to Yahara with your morning movers and a sign that high-end shoppers are still spending. Live from New York City, this is Bloomberg. 60 minutes away from the opening bell, equity futures on the S&P 500 positive by 0.1%, looking to add some weight to a record-breaking rally stateside. On the Nasdaq 100, we're positive by 0.06. Let's get you some morning movers this morning. Let's cross over to Yahara. Hey, Yahara.
Hi, John. The wealthy are doing just fine. Take a look at American Express shares. They are up 1% after it beat results. It is not a huge surprise given all we've heard from economists about the bifurcation of the U.S. consumer and how the wealthy are driving the spending. And Amex is confirming that with its strong transaction volume being fueled by its most premium products. And that is significant because competition in this space is heating up with JP Morgan and Citi both leaning into that. But Amex says that it's ready with a refresh of its Platinum card coming this fall. And we turn to another company that just reported, and that is Charles Schwab. Shares are up 2.3% after beating on both the top and bottom lines, thanks to a flurry of activity in the second quarter. Though there were some weak spots, Schwab attracted $73.6 billion in total net new assets, which did come in below estimates. And we end with some breaking news. Chevron and Hess have closed their deal. We have Chevron rising 3.7%, Hess rising 7.6%. And this is after just this morning we heard that Hess won its arbitration battle with ExxonMobil, clearing the way for this deal, $53 billion takeover to move forward. John?
Yahara, thank you. Thanks for this morning. Have a good weekend. Let's turn back to the big story of the last 24 hours. One Federal Reserve Governor, Christopher Waller, continuing to build the case for a July rate cut. Mike McKee joins us now for more. Mike McKee, how convincing was the argument, and will he find some friends on the committee at the end of the month?
I definitely think he'll find friends on the committee. The question is, how much do they buy into the need to do it in July? We've heard a lot of people, including Mary Daly yesterday speaking with us, say that they are worried about the labor market and they are worried that they could be too late, but that it doesn't seem to have the urgency of a July rate cut. So Waller and perhaps Governor Bowman are going to make the case for it. We don't know how many people are going to buy that case and would vote for it. So we'll not only be watching the news of the meeting, but we'll be watching the minutes to see who spoke up and what they were saying.
Mike, also the statement. Talk to us about the statement and the kind of concessions that maybe the rest of the committee might make to some of the dubs that are emerging on the FOMC. Some of the language there at the moment that might have to change.
Well, the Fed has gotten away from very long statements, so they might try to finesse this by just noting that the labor market has shown signs of cooling. The real question is, how much of a commitment do they make to a September cut? In the past, we have seen negotiations behind the scenes that lead to the Fed not doing something what a prominent member wants them to do, but suggesting that will be on the table in the future. Do they put a rate cut in September more firmly on the future to satisfy Waller and Bowman and to try to get them to vote unanimously in July, or do they let that go by? That's going to be something that Wall Street is watching very closely on July 30th.
Mike McKee, you enjoy wherever you are and wherever you're going next. It's good to see you. Mike McKee there, following the Federal Reserve and the arguments for lower rates at the Fed later this month.
You know, I have to say, the argument for more dissent is one that resonates with me.
Oh, without a doubt.
Given the fact that it shouldn't be groupthink, number one. Number two, this is a complicated, difficult economic moment. It is one where people can have different opinions and different interpretations, and you see that across Wall Street. It might, in that statement, be a really good thing to show an active debate and how different members are thinking about it, because it gives a sense of what the scenario analysis is at the Central Bank of the United States.
And what did he call you, Mitch? What was it?
The you Mitch thing.
That you Mitch thing?
Yeah, not interested.
That's
Okay.
survey.
That you Mitch thing comes out a little bit later this morning at 10 a.m. Eastern Time. Sarah House of Wells Fargo has this to say on the consumer. Headwinds for the consumer persist. Slower job growth and higher inflation are a recipe for weaker real income growth. Joining us now is Sarah House. Sarah, welcome to the programme. Let's get into this consumer and this labour market. What we just heard from Governor Chris Waller is that this labour market is on the edge. Do you agree? Is it on the edge?
I agree. I think it's certainly more fragile than you would expect it from if you're just looking at the top line payroll numbers and the unemployment rate. And we look underneath the surface, as Governor Waller highlighted, slower growth in private payrolls, and also just looking at the breadth of industries adding jobs has been one thing that's really stood out to me. If you look at that diffusion index, it's below 50. We've only seen that 3 times in the past 15 years outside of a recession, and one of those times was just 2 months ago. So I think there are certainly signs that the labor market is more fragile than it looks. We see this with demand continuing to weaken as well. Businesses not using employees as intensely, for example, looking at the average work week. So I think that does challenge the consumer as we move through also a potentially higher inflation period over the next few months.
One thing that John asked Governor Waller that I think is one of the key questions as we talk about the potential fragilities in the labor market is corporate America seems to be doing just fine, and the earnings are actually outperforming expectations, and you're seeing record highs. How do you square that?
Yeah, so I think part of it comes down to, we're looking at some of the biggest, most well-funded public companies, but of course a lot of job creation is by more of your mid-sized firms, of course your small businesses as well. And there I think we're seeing more struggles. So you can see this with, for example, the NFIB hiring plans and the overall index, and also just a lot of the middle market companies that, we at Wells Fargo talk to a lot, they're seeing some pressure as well. So I think it's just like we're seeing in the consumer, sometimes it's a little bit of a tale of 2 sizes here.
Which also raises the question of where we're going to see the investment boom that everyone keeps talking about. The beginning of a new bull market, as we heard Mike Wilson say of Morgan Stanley yesterday when he was speaking with John and Annmarie. I'm just wondering at what point that creates jobs, at what point that creates inflation, at what point that creates growth that people are discounting when they talk about this fragility, these cracks.
Yeah, so I think in some ways, when we look at the productivity potential that we're seeing already, we've seen pretty strong productivity growth this cycle. Still a lot of upside when we think about some of the Gen AI enhancements, but of course that could challenge what we're seeing in terms of overall employment growth, but it's also coming at a time of slower growth in the labor supply. So it could actually potentially be a nice offset to a lot of businesses' needs, and then to the extent that this is productivity enhancing, that's actually going to be beneficial for the inflation outlook.
What's the smaller growth, though, in the labor supply? Governor Waller was just talking about the unemployment rate for college grads at 7%. That feels uncomfortably high.
Yeah, I agree. So again, this is, we're looking at slower growth in the labor supply, but that's coming largely from immigration. We've seen a very noticeable drop off in foreign-born workers in the labor force, but they're filling a lot of jobs that your college grads are not looking for. And so I think that does speak to more underlying weakness and payroll growth slowing, not just because of the supply side, but also because we're continuing to see demand weaken.
So do you think that, Saira, it is all sufficient to say that any kind of inflationary hit from the tariffs will be temporary?
So I think that's a reasonable base case. So that's what we're looking at here at Wells Fargo. So looking for inflation to move up to a little over 3% by the end of the year, but then move back down as we move through 2026, with really the lift coming entirely from the goods sector. We're not looking for that to spill over into services. But I think understandably, a lot of other Fed members remain cautious given the bout of inflation that we just went through. And I think concerns that given how high inflation has been, we're more than 4 years above target, that even just one more supply shock, even if it should be temporary, does that begin to unanchor inflation expectations? So understandably, they're a little skittish, maybe a little bit scarred from the episode that they just went through, but perhaps another few months of data showing that it's not bleeding into services, I think could be helpful and help resume rate cuts as we move into the later months of the year.
Saira House of Wells Fargo. Saira, thank you. Appreciate your time, as always. It's why some members are holding back still. Is 2 months of data enough to get to September and say, we're ready to go?
Yeah, how much are they scarred from their previous experience where they didn't catch up to inflation quickly enough and they said the T word? If they don't want to go back to the T word, it's a little bit worrying some to them. At this point, though, an increasing number of economists, and we keep talking about Mary Daly's interview with Mike McKee, but she also talked about this, that she also is seeing that it's more likely that it is going to be a one-time price shock, especially when met with the weakness that we keep talking about with potential cracks in the labor market.
This conversation will continue at least for the next 2 weeks and maybe the next several months. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Lizzie Burden. Hey, Lizzie.
Hey, John. President Trump has been diagnosed with a chronic venous insufficiency, a common condition causing swollen ankles. The White House medical unit says that he remains in excellent health, though, with no signs of DVT, heart failure or systemic illness. Doctors attribute recent hand bruising to aspirin use and frequent handshakes, calling it benign. Elsewhere, shares of Sarepta Therapeutics are plummeting after the company said another patient has died from acute liver failure after receiving one of its gene therapies. That news follows the recent deaths of 2 teenage boys who participated in the early stage trial for the treatment. The company says it's in discussions with the FDA about resolving safety concerns. And a change in the late night lineup. The Late Show with Stephen Colbert will air its last episode in May of next year. CBS says it was a purely financial decision. The moves come days after Colbert condemned Paramount's settlement of President Donald Trump's lawsuit over a 60 Minutes story. Colbert called it, quote, a big fat bribe. And that's your Bloomberg Brief. John.
Lizzie, thank you. Have a good weekend. Up next on the programme, setting you up for the week ahead. Plus, we'll catch up with Sonal Desai of Franklin Templeton on the tension building at the Federal Reserve. From New York City, you're watching Bloomberg TV. Two days of gains on the S&P 500, going into the weekend looking for record highs after record highs. This morning, all-time highs, up 0.1% on the S&P 500. And so far this week, the equity market bulls getting a lot of what they want. Decent earnings from the banks, decent data so far in the economy in the United States, and even someone who was bearish standing very bullish, even Mike Wilson and Morgan Stanley, likes this market.
People like the idea of this investment cycle, and I really can't emphasize it enough. When I talk to people, there is an existential fear that they cannot invest enough in technology and they are going to lose their entire business if they are on the back foot. And that is the reason why it's not just the tech companies. There's a feeling that corporate America is going to withstand. Also, the consumer's holding in. I mean, people are still traveling. People are still going out to eat. I don't know. It's really expensive, except for you. But I, would live in a box. So there you go.
You spoke to Scott Kirby of United. I keep going back to this. What we're hearing from the airlines is so different to what we're seeing in the data. Even on the airlines, and airfares.
He said that it was like a switch that went on after the one big beautiful bill was passed. Also, some of the disruptions in the Middle East definitely relieved some of the pressure when you saw sort of an end to that. There's just a question here. Who's right? Is there weakness or isn't there? Are Americans just sort of conditioned to spend money and so they want to keep doing it? Is it sort of a secular trend toward travel and away from physical goods, or are things not that bad? And actually, there aren't the cracks emerging that some people are worried about.
Can I go with the second one? Number 2, conditioned to spend.
I mean, yeah, and also, you got to get the Instagram. It's all about the
gram. They say never bet against the American consumer.
It's true.
They just keep on spending. Check out the bond market. Bonds a bid, yields are lower. We're down 3 basis points at the front end of the curve on a 2-year, 3.87. On a 10-year, down 3 to 4.42. A bond market rally. After this, we caught up with the Fed Governor, Christopher Waller, who's calling for a rate cut this month.
One of the things that has always bothered me since I took this job is the criticism that we are nothing but groupthink. All the meetings are the same. Nobody dissents. Nobody does anything. And I think this is healthy. I think this is a turning point in the way we want to think about policy. Some people don't want to cut. Some do want to cut. But coming out and making the case either side, that's good, healthy debate. Otherwise, if we're always going to do the same, the joke is, why don't you just have one person set policy and send the other 18 FOMC members home? So this is healthy. I think this is what you want to see in a democracy. You want to see policymakers have serious, open discussion about where policy should go. It doesn't mean anything about politics or anything else. It's make the economic argument and then see if you can convince others to go along with you.
You never know what someone's thinking, but just listening back over that, my interpretation of it was a man who was very sophisticatedly navigating a very important issue, communicating that it's not one-man rule on the FOMC at a time when a lot of pressure is building on one man.
Yes, and so on one hand, you could interpret this as giving him a pass in terms of Jay Powell making all the decisions, or you could say, well, there are other voices that can be heard at a time where people are increasingly saying his voice carries quite a bit of clout given his potential role at the Fed.
Another stealth argument he made towards the end was talking about inflation and credibility. Without credibility of the central bank being independent, inflation expectations would spike. And he said, I know that, and Scott Bessent knows that. So basically talking about the fact that whoever is going to be the Fed chair next, everyone in the White House knows that person needs to have credibility, because inflation expectations will then spike, which is exactly what this administration does not want to see.
The opening bound's about 42 minutes away as we work our way towards the weekend. Just a sneak peek of next week for you. On Tuesday, you will hear from the Fed chair, Jay Powell, speaking at the FOMC's regulatory conference. On Wednesday, more results from Tesla and Alphabet. On Thursday, a rate decision from the ECB, and we'll get more earnings from Intel and American Airlines, plus another round of jobless claims. Let's stick with the week ahead, and Fed chair Jay Powell speaking on Tuesday as President Trump ramps up the pressure for a rate cut. Sonal Desai of Franklin Templeton writing the FOMC is already envisioning several 50 basis points of rate cuts this year, followed by more next. I happen to disagree with the policy, but I also think this confirms that the Fed already has a dovish bias. Sonal joins us now for more. Sonal, I just want to get into your thoughts on where you stand on this rate cut debate at the moment. Why don't you think a rate cut, currently at least, is warranted?
Okay, before I get to that statement misstated what I was saying. The FOMC foresees 50 basis points of rate cuts this year and several rate cuts next year. And I think that is probably not warranted. And really, because the economy is kind of doing fine. We've talked about this several times in the past. I happen to think that the neutral Fed funds rate is between 4 and 4.25. We've talked about this before. 2.25 of inflation, 1.75 or so of productivity gains. Unless it looks like recession is imminent, it's not clear to me why the Fed should be cutting rates all the way down to close to 3% in this environment. We have become used to extremely low rates. And prior to the global financial crisis, we had decades of rates being more normalized. And that's why I don't think it's needed.
Sonal, that said, a lot of people do expect the Fed to cut to that level that you're talking about, and you're not seeing an unmoored level of inflation expectations baked into the market, as Governor Chris Waller was just saying. So do you think that the market right now is underpricing the potential for future inflation?
I think it is probably. And the point is, the future inflation that I see is probably not associated, let me be clear, with tariffs. For a number of reasons, it's not just that they're one-off. Frankly, tariffs don't impact enough of the CPI basket to have a meaningful impact on overall inflation. The real reason is fiscal policy remains very loose, monetary policy is not particularly tight, and we aren't seeing unemployment do terrible things. Wages aren't doing terrible things. This is an economy which remains in relatively good health right now. And that's why I think we aren't seeing the pressures. What brings inflation down? Let me turn it on its head and say from its current levels, which, by the way, are 50% higher than where the Fed needs inflation to be, what brings inflation down? Well, I don't see very many factors.
One thing that people argue is you are seeing, I don't know if it's cracks in the labor market, but a sign that private employment really is coming down. And you saw that really in the last non-farm payrolls report, which is what Governor Waller was talking about. But you're hearing companies say this as well, that they don't have the same kind of pricing power that they did in the direct aftermath of the pandemic. So at what point will that pushback that you're seeing from the consumer act as a check? And something that really is consistent with what we're hearing from corporate executives.
Once we see some more, once we can hang a bit more meat to that particular story, I'd say I would agree. So far, it's a data point. It's a few data points. And actually, we've seen some fairly decent corporate earnings as well. We got yesterday's retail sales, for example. I really don't know that we're at the cusp of something dramatic happening to this economy. And getting clarity on the fiscal front, whether you like the bill or hate the bill, we do have clarity from the bill. That actually is a corporate tailwind, not a headwind. So I'm not yet prepared to say that we're getting to a point of significant weakening of this economy.
So does that mean, Sonal, that you're all in on a high yield and you're shorting the 30-year?
No, I'm aggressively neutral on rates in general, and I am looking at, if I think about all the different factors which come into play, I think fair value for US 10 years is actually probably around 475 to 5. Do we get there? It's not completely clear. Weirdly enough, actually, after being concerned about fiscal for so long, I think something that people might be underpricing is that if tariffs go through anywhere close to the level we've seen so far this year, we actually have an additional source of revenue which has not been factored into anybody's calculations. And it's quite substantial, actually, the type of revenue which is coming in. So there are lots of unknowns here. I think that the spreads we're seeing on high yield are extremely tight. That's very clear. I think you need to be very careful. So it's not that I'm all in. I'm just looking at this and waiting for some volatility to continue to pick up interesting credits in interesting places. I don't think you can buy any indices, which you would do if you were all in and spreads were enormously attractive.
So now, you also think the markets are just overhyped when it comes to the controversy between Trump and Powell. Are you willing to close that door then about the White House and Trump potentially firing him? You just don't think it's going to happen at all?
It's not a question of happening or not happening. I don't think it matters, is my point. You would get volatility if he fired Powell for cause, if some of the current controversy results in something meaningful, which I'm doubtful about, but supposing it does, and supposing Powell is fired. I would just note, what exactly is it that we're all terrified about? An enormously dovish Fed chair? Can I ask everyone on the program today, who was our last hawkish Fed chair? Let me tell you, it was Paul Volcker. You have to go back 50 years, yeah? So let's not act as if getting a dovish Fed chair is something none of us have ever encountered. I give you Janet Yellen. I give you Jay Powell, who actually did preside together with the supremely dovish Fed over one of the biggest policy errors that we've seen in a very long time. That policy error was not to be overly hawkish. It was to be overly dovish. So I think when I say it's being overhyped, it is this notion that somehow we're going to get someone truly beyond the pale who is going to come and knock monetary policy completely off course. It's 12 members who get to dissent or not to dissent. I think that the institution has a certain amount of credibility, and no incoming Fed chair, who, by the way, survives this administration and whose term will run into the subsequent administration would like to have his legacy fall under that footnote that Arthur Burns has in the annals of the Fed.
You ever seen that scene of a bunch of football fans watching the game and they score?
Yeah.
And then all the beers get thrown into the air.
Yeah.
And now people have put different video in that screen and then they throw all the beers into the air. That was Sonal design, the big screen. Yeah. And it starts going on that rant about the Federal Reserve.
Yeah.
All the beers getting thrown into the air, everyone's going crazy.
Yeah, that's very much. That was a fantastic explanation and, frankly, history lesson.
Sonal, thank you. Sonal Desai there, Franklin Templeton. It's got a point, and a point a lot of people, I think, will share.
Yeah, the idea of no one wants to be Arthur Burns. No one really has the stomach to be Paul Volcker either. And that's certainly what we've seen over the past, what did she say, 40 years?
And Paul Donovan recently made the point this week with Danny Berger of UBS that actually that Arthur Burns type Nixon relationship, where on the surface you think this person is independent, but actually what they're talking about, you see later years in the minutes, is pretty much what Nixon was saying. He said that is the worst type of Fed chair we can get.
Where are these weeks going? They're just flying by, aren't they?
Well, I mean, how you think about what's happened in the past month. I mean, I can't remember half of the things that were headlines that dominated our life.
August is going to be fun. 2 more weeks of July, of course, but a couple of trade deadlines in the mix. Should we go? I think we should go. Coming up on Monday, Laurie Calvasina of RBC, Bob Michael of JP Morgan, Tony DeSpirito of BlackRock, Chris Harvey of Wells Fargo. From everyone here at Bloomberg Surveillance, thank you very much for choosing Bloomberg TV. Have a wonderful weekend. This was Bloomberg Surveillance.